there. So till 1:30 is completed, I guess. Hemant sir.
Yeah.
Yes, sir.
Okay. So I'm clearly audible, right?
Yes,
Yeah,
sir.
yes, sir. Clear,
Okay.
clear.
Welcome, Sarpabhushan sir.
Thank you.
Good afternoon.
We will wait for 5 minutes so that all the participants will
Right.
join.
We'll check. Let all join. So how is your preparation going on? You started at least glance.
Brushing.
Only
Yeah.
50 hours training, sir. Right. Once after completing this, we will start, sir.
Because this session majorly, plays a vital role to understand what is the total syllabus covered and the way the institute is expecting us to be prepared. That is why 50 hours is always a major role. Apart from that, we need to be very thorough in concepts, which will anyhow come once you give the examination. Once you give the examination, the understanding of thoroughness, the questions, what they're expecting, the examiner's point of view, you will understand only once you get into the examination. So let's see how things will get into the. How many people are there in this group now? As of
I think participants 8.
participants are 8%, right? Okay.
That is what I.
Okay. It's a good group because number of people are less, then interaction will be more, and you also will build the relationship longer.
Yeah. It is.
Once you save these people in your list, so that it will be because our profession requires the networking.
Yes, sir.
So
You
you are
are
a GCAR officer?
Yeah, we are from one of person is from GK office also joined. Okay.
Sarpabhushan.
Sarpa Bhushana.
Your name, sir?
My name is Sarpa Bhushana.
Ah.
Yeah, today's session is mine only. Okay.
Because that I am seeing GCAR office. That's why I just called.
Yeah. One more part is one more.
I think you are also one of the partner for GCAR group.
Correct. I am associated with Gopal Krishna Raju, sir.
You are stationed in Bangalore?
We are situated in Chennai.
You are also sitting there only?
Chennai, same. Let's have an interaction. Maybe people started joining here.
I think 9 already participants.
I think we have sufficient participants now.
All there?
I think 9 participants are there.
Okay. Let them come. Time is there. Now only just 2:30. So 2:35. Good.
May I know who's the name of GKR office?
Is one of the person in office staff, GKR office staff.
Okay.
Normally, GKR sir used to attend this session. Yeah. Vijay Kumar sir ji.
Yes, sir.
How are you? This is Sarpa Bhushan here.
Thank
you. Yes. All are joined, or how is this?
I think we have given enough sufficient time to the participants. Now I think we should start, sir.
It's fine, right? You can start.
Okay. Good afternoon, everyone.
Good afternoon, sir.
So our today's second faculty is C.S. Sarpa Bhushan, sir. He's a practicing chartered accountant, a qualified registered valuer. and is 8 years of experience and qualified experience in the industry, and serve as branch manager in Reliance Capital, and also work finance manager as Al Ilaha Group companies, which is reported nation of UAE and Dubai. So he's going to take up a section for the fixed income securities for the case study. So now I request to Sir Bhushan sir, sir, please take over.
Thank you very much, sir. I'll just take into the session now.
Okay, sir.
Good afternoon to everyone. So it's nice, first outset, I need to thank to the institute, All India Institute of Valuers Foundation, for giving an opportunity to take this session, and also very sincere thanks to the Gopal Krishna Raju sir, who has also recognized me to take this session, and Vijay Kumar Sarji is always being in touch with me regarding very active person where I have seen, and previous session faculty Hemant Kumar sir also very energetically has completed his session now. So let us start our session today's. Okay, we all know that today's session is very much about fixed income securities. Especially my portion is only to talk on the uh, case studies portion. Theoretically would have been already considered completed, I guess. Anyway, by interacting ourselves, we'll come to know what extent we have already completed, and what extent we have received the topic. Thereby we can consider, go with the practical aspects also. Before to that, we will understand overall in the participants, what extent of profession, what is their profession, and what is their background. It will be better for these case studies. Why? Because theory you can listen, understand. When we are going to the practical aspects, we can understand what extent I am already confident, and thereby I can go or smoothly, or very I can go very fastly, so that you can cover so many questions. Something like that we can analyze, and also have a good contact also with you people. So can we introduce ourselves? Myself, I'm a chartered accountant. My name is Sarpa Bhushna. I'm chartered accountant. I'm practicing, as you already informed by them. So, Mr. Arun Vishwanathan, yeah, can you tell me about yourself?
Yes, sir. I'm Arun. I'm a qualified cost accountant and company secretary,
Very good.
practicing as a cost accountant in Hyderabad.
You're from Hyderabad.
Yes.
Okay. So in your session, your syllabus, when you completed, you had a derivative as your syllabus.
Yes, sir.
You had it, right?
Yeah.
So you know the options and the bond valuation, all these things.
I know, sir, but I don't know how much I know, but I know it.
No, that's fine. That's fine. Even though the valuation prospects will be entirely different, because whatever we studied in cost accountancy or the chart accountancy is a different perspective, where the understanding will be different, wide enough. Here very much specific. He is asking what is the valuation oriented expectation. So how, as an valuer, how you are going to take the assignment of bond valuation or an option valuation, how you are going to understand the concept when it comes to the practical scenario. That's what that angle only we are going to learn, and also examination is also in that perspective only. So not much worried part, because most of the people here, whoever thinks that options, when comes to the word of option and bond valuation, people think that it will tough, that will be there, but here it is not so. No need to worry on that part. We'll try to go with very smoothly and slowly. And Purushottam Sarji, can you explain, introduce yourself?
Sir,
Um,
I am from Mysore, practicing cost accountant. After serving
Okay.
39 years in public sector industries.
Very good. Great, sir. Great.
But basically,
You're from Mysore.
business valuation, I have not studied so much, because at that time the syllabus was not there that much. Now
Okay.
only in the CMA course also some 50 marks syllabus added.
Okay.
But when the study material shows, it is not so much.
Okay. No worry. Study material is one part of guideline only, but we need to get into the so much, because we are going to use so many different source of information to get the required knowledge. Even Google is always supportive for us to understand overnight studies. You can just Google it and understand what particular words speak about. Because overall, if you see the valuation syllabus, it is not, neither we have a separate book for that. Okay, we don't have a specific area of syllabus. It is so vast, whatever the area. And also, even though they covered up in lines of English, the syllabus, whereas when it comes to the examination point, the questions come from very different aspects. It will go, you cannot even expect, oh, this is also in our syllabus, that extent. Because they covered that point in the syllabus, whereas the concept which we never expected, that concept they're going to check. That extreme examination point will be there, because it is a multiple options question.
Also, I am the vice chairman for Mysore chapter of cost accountants.
Oh, that's great, sir. Very nice to know, the senior person here. Good, sir. How you feel about the options in this particular options? Is okay, you already covered
GK covered one session for
Yes,
2 hours.
Yes.
And after going through his blog also, I am able to follow or
Very good.
understand something.
Very good, sir. Very good. That's enough, because GKR sir is always a valuation milestone. If he starts speaking, you can entirely. And also, whoever wish to qualify very soon, you have to attend his classes. Such a nicely he will take fast track. Almost across the country, people are attended and get benefited of that. There is no doubt.
You can know the specific point, where to touch, where to go, how to go, where to pinpoint. That is, classes are really. It's not hurting.
Should be connectivity issue.
Connectivity issue. Yes.
मागच्या बाजूला
Sorry, some technical issues. Very sorry. So, Govardhan Sarji. Yeah, nice.
Yes, sir. I am from Chennai. I am a practicing chartered accountant.
Okay.
I have no. I was with the industry earlier.
Okay.
So I was working for Mahindra. Prior to that, I was with Alstom.
Okay.
Then I started my practice.
Very good, sir. So, when did you completed your CA, sir? In which year you completed?
2006.
2006. So you mean you had options and derivatives in your syllabus earlier?
Yeah. In fact, that is one reason actually which took so long for me to complete. because I completed
Oh,
my
that's great.
group 2 in 99 and I
Very
completed
good.
my cost accountant CWA in 99.
Oh,
So this one group was dragging me.
okay.
The transition of old syllabus to new
Okay.
syllabus.
Okay. So somewhere SFM was a little complicated
Yeah.
area. Okay. No worry. We will make it easy because valuation prospect, as I told you, even though we are very much bothered about the options when we see it, spot, exercise, all these things, when comes to the valuation prospect, what kind of expectations from the examiner will be different. That way we will go and then we will understand the concept. Thereby we will be able to clear the examination or whatever, get the concepts also very nicely. So next to the Vijayalakshmi madam. Uh,
Yeah, sir.
yes,
Good afternoon, sir. Vijay Lakshmi. I'm a practicing chartered accountant from Bangalore.
great.
I qualified in the year 2007.
2007.
Yeah.
Great, great, ma'am. Now you are into practice, right?
Yeah, I'm into practice. I have a firm of my own, Mr. Nityananda. I'm partnered with Mr. Nityananda.
That's great, man. That's great. Okay, okay. So you also had a options in your syllabus, options in bond value. So it's good that many people are aware about the options. And Shraddha Declo, yeah, something.
Tachulia.
Yeah.
So my name is Shraddha Tachulia. I'm a company secretary by practice, and I've been in the employment for around 7 to 8 years.
Okay.
But I'm not so in at present, and I'm Kolkata based.
You are now into practice, ma'am.
So not yet started, but
Okay.
hoping forward.
That's good. That's good. Anyway, good to know about you. And Shalini, ma'am.
Hello, sir.
Right.
I'm Shalini. I'm a practicing company secretary,
Okay.
and I started my practice since 2001. Till then, since then, I'm into practice, and I'm basically into FEMA matters and this company law matters.
Very nice of you, ma'am. Almost 19 years of experience in company secretary area. Very good.
Yes, sir.
About Manmohan Sharma, sir.
Good afternoon, sir. I'm a chartered accountant
Great,
in
sir.
practice since last 15 years,
Oh,
and I've recently done IRP exam also.
that's great, sir. So you have all the grip on the IRP so that it will be easy for you to gain the certificate of evaluation also, because the valuation, most of the concepts are covered in that IRP. The separate act is also there.
But education is something different and practical is different.
Yeah, that's correct. That's correct. But practical aspects, yes, of course, it is always be there. But theory, as examination point of view, you almost covering 3 to 4 marks from the IRP examination.
Yeah.
So that's not issue at all. And that's good. When did you qualify, sir? I mean, you have a options knowledge earlier to the profession. I mean, because most of the, why I am asking specifically this one is, CA, CMA people are company secretaries. If they cover in their subject, as a syllabus, as a options, it will be already they have a grip. Some extent they will understand. But in our CA syllabus, before to 2005, there was no derivative concepts.
Yeah.
So that's why I'm just checking if they were having different, some MAFA kind of subject was there where the derivatives were not covered.
Mm-hmm.
Derivatives were very recently topic. So you covered in your earlier
No,
syllabus?
no, I did not.
No? Yeah, no worries, sir. That's great. And how about Mansi, ma'am, G?
Yeah. Good afternoon, sir. This is Mansi from, I'm from Pune.
Okay.
And I'm working with a service industry. Companies into ESOP related services, ESOP valuations, ESOP plan management, conceptualization and all.
Okay.
I'm 2017 pass out.
2017 pass out. Okay.
Yeah.
So ESOP is one of the good area for valuation profile, because now valuation profession itself much wider spread in that area. You can really get the good knowledge after
Yes.
getting this one. Most of the options are coming, valuation prospects are coming only from the ESOPs and valuation of listed company shares. It is good that you are also part. Mr. GKR sir is normally takes very nicely on that topic.
Yes.
Let's
He has
one
taken.
day we'll hear from him also. Yeah, good. So almost 6, 7, 8 members are there here. Okay, that's nice. So we'll start with the initial options only, as we discussed. Before to that, I will tell myself, almost I have been interacted almost around 1,500 members who are a cost accountant, chart accountants, and company secretaries who are aspirants to the getting the qualification of valuation examination. And most of them all are attended GKR's fast track classes, all those things. So normally they used to be contact with me. Most of the examination, whoever is appears the examination, they comes to me and then tell this is how the examination question was there, and how to try, crack this. It was very tough for me. And keep in that it is not one go examination. At one time you will go and sit and come out of examination. No, it is not that kind of exam, because unexpected questions are mostly expected in the examination. Thereby you need to be very thorough with the subject, and it is no what is that, no wrong in that appearing in the many times examination, because the institute itself in the guideline rules itself, they say it, as many times they want they can appear the examination, right? In the company's rules, the valuers rules itself, they mentioned the participants can appear as many times as they want. It means they already knows we are going to ask you in such a way. It is not that making you to scare on the examination about that, but thing is concepts are very deeper. We go with this, and also most of the people already know about the examination pattern also. If not, I will try to explain you also again, not issue. Total 83 questions will be there in the examination. Total 83 questions. Of that, 3 questions will be practical questions, which we are going to see now. Only 3 questions. Okay. Total 83 questions. Of that, 3 questions are practical questions and 80 questions are theory questions. Got it? So 3 questions, again we are breaking down. Three questions we are again breaking down. One is 6 marks question. Another one is 6 marks question. One more question is 8 marks question. I understand this is our afternoon session. After food, it is very tough for you to get into the session. Anyhow, no worries. We'll try to make it very slowly with very concept oriented, and also understand what the examiner expects also in this way. So whereby 20 marks is covered by this 3 questions. One is 8 marks, another one is 6 marks and 6 marks. Total 20 marks. Balance 80 marks is come directly one word answers, which is 80 questions. Okay, so you will be having examination 83 questions. Of that, 3 questions are reserved for practical aspects. So our passing score is 60. You need to gain minimum 60 or 60 plus, irrespective of the number of attempts, whatever you are taking. Once you qualified, you see number as a 60, you are out of the examination. That's all. So how to gain this 60? That is the main thing what we can discuss. Surely we'll discuss along with the class, overall class today's. Most of the thing is everybody has to be very thorough in the practical aspects, whereby you will get 20 out of 20 easily. 20 out of 20 easily, because it is neither doubtful nor thinking of it. It is only if you understand the concept and apply the problems, you will be able to get immediately 20. There is no doubt. Whereas theory is not like that. The same resembling answers will be there. It will be so difficult to choose that it is the pakka correct answer. No, very tough, because the way questions they expect and the deeperness, though you read it yesterday night before to the examination, all the twistness will makes us to get confused, so that you will mark for review, and then again keep it for last hour, and then we'll get confused. So what I'm trying to say is, our problematic area is always supportive for us, so that we'll try to tackle this very easily, very concept oriented, and very examiner point also we'll see. It's not that concept we already knows everybody. Even tomorrow, if any practical aspects, if you give valuation, you will able to understand, yes, this is the value. Because valuation, as you know, valuation is not the what 2 plus 2 is 4. No, it is not like that. 2 plus 2 can be a 5 by individual value or perspective. Okay, you can predict. There are so many kind of different kind of valuation can be done. One is buyer perspective, one is seller perspective, One is independent perspective, correct? One is government authority perspective. So the same property can be valued in 10 perspectives. Understand? It can be valued in 10 perspectives. And 10 valuations also having a different numbers. That is the beauty, because the buyer prospective valuation will goes with the buyer considerations. What input, what he is expecting after buying this property or after buying this particular shares. What is his way? Investment or acquisition of the controlling interest of the company, correct? Right? No. So when I am buying, I'm trying to, as an Sarpabhushana, I am trying to invest 10 crore rupees in one of the company shares. I will go with the Gopal GKR sir. Sir, can you please assist me to understand this particular company's investment? I am trying to do the investment. Immediately, sir will ask you what prospect you are planning to go for. You are going to get the company's acquisition, or you are going to get the investment, only short-term investment, long-term investment, right? I have a 10 crore rupees where I want to gain the most of the income immediately by speculative way. 1 crore, I want 10%, I want income immediately. Whenever market goes up, I want to withdraw. Then the valuation will be different, because the short-term, whatever the concepts influencing those kind of shares will be considered in the valuation prospect, right? However, if you are going to invest the 10 crore rupees for the acquisition of the interest, company's interest, then the valuation concepts will be different. Though the upcoming days in a future short term will be very pathetic. However, you can analyze the free cash flows of the future expectations of the company. Then you can value accordingly. Thereby, the buyer's perspective is different. Again, seller, why I want to immediately sell this company? I don't want to keep more money, further, no further keeping all these things. That way, if he is having, there'll be less kind of considerations of all. So that way, valuation is, it is not the rocket science, or it is not a science to say yes, 2 plus 2 is always a 4. It can be individually differs. That is why we always understand what expectations are made by the valuation assignments. Now we'll go with the problems, options. Where is that? How to share this? My screen is visible, right? Okay. I'll just try to keep. So we'll start today's session with the options. As we all know, the syllabus coverage of this one, you can make a note of it already. You can download directly from the IBBA website. The syllabus is given, and we are particularly taken the fixed income security syllabus, which you already comes to know through GKR sessions. Option valuation, general principles, option valuation models. So where we will understand what is option valuation models. So as I already mentioned, we are going to see the valuation portion alone, practical aspects. Thereby, we will understand how many models are there to value the options. One is Black-Scholes model. Second is Black-Scholes, Merton option pricing model or method. Third one is binomial tree method, nothing but binomial method. And fourth one is Monte Carlo simulation method. These are the only three or four option by Merton, inserting the Merton, it is becoming four methodologies to value the options. The Black-Scholes was initially done by for the understanding and valuing the European options. Later, they were tried to insert all the way, we can American option also. They came up with the American option valuation also. But initially, it was taken only for a Black-Scholes model, this European options only. That you can keep it, because that is also one theory question out of 80 questions. This will also be one question, because Black-Scholes initially taken for what valuation purpose? It is for European options only. They were valuing by using this model. Binomial tree method and Monte Carlo was very different in nature. Binomial tree options, binomial itself says two possibilities of the options expected price. Say either this way go up or it may come down. Only two probabilities are expected in binomial tree or binomial option pricing model method, whereas my Carlo simulation method was brought to understand the very difficulties of this in a market, because you cannot expect a price may come or down. It may come up, down, it may vary, zigzag it. So that situation, how to handle that will be explained by Monte Carlo simulation method. Then the valuation of financial assets like non-financial liabilities, all these things. Before that we'll go to the understanding what is options. As you already informed that theory part is covered by sir, so we will not get into the total much theory area and all. Before to that, we'll for the requirement of the problems, we'll go with the uh, basic information. Let us start spot price. You know the options, right? First, options means it is an option. That's it. It is an option to buy or it is an option to sell. Who is having that option? The option is having only with the holder. Whoever is holding that option is having an option to buy or an option to sell. Then who is having an obligation? Who is a writer? Who is a writer of the call or put option will be obligated to sell or buy. See, either of the one party has to get obligated. Then what is that option, sir? What option is given to them? Tomorrow, I'll give you an example. Today, the share price of the share price is 100 rupees. Today's share price is 100 rupees. I am planning to take this share not today, by exactly the same day of the next month. But I am sure that this company, as a bullish, I am thinking this company go very high in future by coming months. So I just wanted to secure myself by edging something like options. What I will do, I am expecting myself that this share can reach by 120 rupees tomorrow. The next month of the same day will be this pricing of this share will be around 120. So what I will do, I will go and search a person who is ready to sell on that day as a writer. I will ask him, can you sell this share on the same day of the next month for 110 rupees? Then he will say, yes, I'm ready to sell you on that day. Irrespective of the market price, I'm ready to sell you this particular share. Then I will think, okay, I expect 120 rupees as next month price, but today's spot price is 100 rupees. Then I will enter an agreement between the writer. I am a holder. I'm going to become an holder of the call. I will say, I will take this option only if agreed to sell 110 rupees in the next month. It means what? I expected 120, but I am going to agree to buy on that particular day for only 110. So thereby I am expecting 10 rupees profit by making this call option. By making this call option, I may get 10 rupees profit. This is my intention. That is why I am calling that writer to come and then enter into an agreement. So in this particular scenario, what is spot price is the 100 rupees. Today's current market price is called spot price, correct? Then what is exercise price or strike price is called what is we are going to agree. We can call it as agreed price, agreed between the holder and writer, agreed price. So what would be that agreed price? 110 rupees, correct? 110, correct or not? Yes. So agreed price is 110. And what is my expected price? Expected price is 120 rupees.
120.
Correct. So we are not going to discuss anything on the 120 rupees because it is only my mind says that it may go up to 120. So now why this guy particularly, he also think that it may go up to 120. Why he has to sell at 110? He is thinking the bullish way, that bearish way, that the price may come down. Okay, price may come down. Now it is 100. It may go even 105 only. Maximum it can reach only to 105. But this person is ready to take this share by 30, 110. So why can't I enter into the agreement? That is his perspective. So he is collecting the premium, call premium. This is the story total options, how this options works. So we know that who is the holder of the option? Option who is purchasing the right to buy that particular day is called holder of the option. Writer of the option is a person who is going to sell, obligated to sell, not only sell. Obligated. What is this obligation means? The obligation is like this. In the given scenario, what I explained today, that next month the price is, instead of 110, it reaches to 120. Then the writer, as a holder, I will say, I will not going to the market. The holder is always thinks which is favorable to him. You understand? This is very, very gripping point, very much important point, because the holder of the option is always thinks which is favorable to him. Whereas the writer of the option is having no option to think of favorability. Just keep in this mind. Holder of the option, I will repeat, holder of the option always thinks favorable situation. Writer of the option is not having an option to think of favorability. He is bind to sell, bind to put. If the holder asks, you give me, he has to give. That's it. There is no option for him. So this is the basic concept you need to understand. Say that given scenario, 110 rupees my exercise price, agreed price, but tomorrow's price become 120. Tomorrow's price become 120. Then the writer has to sell the shares to 110 only. I will not be, as a holder, which is favorable to me. If I go and buy in the market, it is 120. If I buy from this particular writer, X party, I can buy at 110. So I will go always with the agreed price. However, the scenario is different. When the price goes down below the agreed price, say for example, 110 is our agreed price, whereas market price was only 102. How much? 102. It means 102 rupees was the market price on that day. What I will do, as a holder of the option, I am holder of the call option, I am having option to buy from the agreed party, or I can directly walk into the market and buy. So if you are an holder, what will you do? Anyone can tell. If you are an holder of the option, what will you do? Will you go with the agreed price? I agreed with him to buy 110 rupees.
Buy from market.
Exactly. You can directly exactly walk into the market and I will buy the particular call. Thereby, the entry, whatever we entered into in between the agreement, no, that becomes lapse. That becomes lapse. That is why the value of the call, when there is a out of the money, this situation is called out of the money situation, OTM. Out of the money situation, the value of the call become 0 because it is lapsed. I'm not interested to exercise the option, so value of the call become 0. The next scenario is I agreed for 110 and market price on that day is exactly matches my agreed price 110. What will you do? What will you do? When the market is also sells at 110 and your agreed price is also 110, what will you do? Will you buy? We will search that party. Where is that guy who is entered between the agreement? I will go and then I will hold his collar, give me 110 rupees. Will you do that? No. Because why I have to buy? I directly can go walk into the market, I'll get the same buy, right? When the exercise price is equivalent to the market price, I will not exercise the option because I no need of exercising the option. It is already available in the market, readily available in the market. Just by clicking the button, I will purchase the option. Thereby also, I will not exercise the call. There also, when the call price is, exercise price is equal to the market price, then your call option is become lapse, zero. You can just note, make a note of it. When exercise price is equal to market price, the value of the call option is become zero. It is also lapse there. It is also lapse there. So why? Because holder is always having a favorable situation. He can opt for favorability, which is very much favorable for him. He can take, whereas the writer is not having that option to get the favorability. That is the basic understanding of calls and put option. Put option is, you know already, call means I am having right to buy. Put means I am having right to sell. Hope everybody knows this. Yes, it is an opposite. I will also explain this put option also better understanding. The same scenario, market I expect, I am a bearish person. I think today's market price is 100 rupees. I think this price will not be there in the next month. What I will do, I will enter into the agreement, put option agreement, saying that I want to sell this on the same day, 110 rupees. Will you be able to buy on that day? Then that guy will say, yes, I'm ready to buy. He expects that it may go up to 110 or 120 or something like that. But I am thinking it may not go to 110. So I will enter a contract with the writer saying that I will sell to you irrespective of the market price. I will sell it to you on that day, particularly 110. If suppose on the day of the month, the price become 102 rupees, I have right to sell. I have right to sell at 110 rupees. He has to buy from me at 110 rupees. This is the difference between call and put option. So we'll go to the next call option. You can read the theory what is displayed here. It is only a matter of theory what we discussed only. On the expiration, the wordings what we used only the same thing. Spot price, holder, writer, strike price. You are already understanding this wordings, right? You are able to understand this whatever discussion, right? Okay, you can just nod your head so that I can understand. Yes, they are going, because no need to unmute also. So that I can understand people are able to be with me. Then the valuation of options. As I already discussed, valuation can be done only by using 3 models or 4 models. One is Merton model also considered, means it is a 4 models. It is again 1 mark theory question. They'll give the question like this: valuation of options can be done by using the following method. Except they will tell all these 3 except one complete valuation method. Then what is the complete valuation method? There is no such method called complete valuation method. So that will be the answer, 1 marks question. So this is the way the questions will also be there. As we discussed, Monte Carlo simulation method is always goes with the very random probabilities what future can come, not only expecting the up and down. It may expect what is the scenarios which may come, worse scenarios. So random probabilities it will always thinks, and it is goes with the random payoffs. Not only, and it is used when simulations are various source of uncertainty. It is not that one uncertainty, either it go up or it may come down. There is no such situation. It may expect various scenarios. It means Monte Carlo simulation method is applied only when there is a various source of uncertainty and multiple complicated problems. That time only the Monte Carlo simulation method are used. So you can understand the question. You can just like this will be the question. Monte Carlo simulation gets its name from which of the following? Data collection, model formulation, trend analysis, random number assignment?
Random number.
Huh?
So be model formulation.
Not one.
My voice is not audible.
Let's audible.
It's audible, right? So what would be the answer for this?
The B
Random.
model formulation.
It is a random number
Random
assignment.
numbers.
It is a random number assignment because it is not that go with the one chronological way. It will expect all the way what are the probable kind of things that comes for the expected future. So next one question is why I am taking the theory part for the Monte Carlo in the case study session, because there is no proper cases available or because it is very difficult kind of practical oriented situations only it will be resolved. The same will not be expected in the examination, because examination you be understand that examination and examiner will not expect you to go with the very typical very headache kind of problem will not be given in the exam. You will understand whether you are able to understand the basic concepts if the situation gives, and what is the time given, specified time, no standard time, whatever the given time, you are able to cover that particular aspects. Though the stuff is one question covers 10 questions, it can be modeled, but they will ask only 3 questions out of it. It means the given problem might be very big, but solutions only he expects only 3. That's it. Only what would be this, what would be less. So reading the problem, by reading the problem, you no need to worry on that. They will be sticking to the your time, standard time allocated for that particular problem, and they will ask only to that extent. However, the probability of coming the different kind of concepts will be more in that. So Monte Carlo simulation ensures that what? It ensures what?
The
As we
simulated
discussed.
probability distribution will be the same as actual probability distribution.
Correct. See what it says. Probabilities must be at most of 2 decimal places. Is it so? Probability is not required to be most decimal 2 decimals. It can be in 5, 6 decimals also. So out of that, these 2 options are out because this is not the answer.
Right.
Correct? This is not the answer. So immediately all of the balls are gone. The next, only one uncertain decisions can be in any of the simulation model. Is it so? It is the various uncertain
Yes.
models. That's why this option is not correct. The answer is simulated probability distribution will be the same as actual probability distribution. Correct? Answer is A. So now we will go with the understanding how the problems in the examination. This is an exam kind of problem repeated so many times, but why we are taken this as to make you understand that what is the expected way we need to learn in valuation of options. You can read this particular problem, then we'll go with the solution in Excel. Okay, you just try to read this problem. My screen is visible, right?
Yes, sir.
Okay. Mahadev, an investor, is an investor. Mahadev is an investor, had purchased a 4-month call option on the equity shares of X Limited. The face value of the 4-month call option is 10 rupees, whereas market price of the option that call share is 130 rupees, 132 rupees. You understand? Face value of the share is 10 rupees. Market price is 132 rupees. And exercise price is 150. He is entered agreed price for that particular option is 150 rupees. Mahadev is expecting the price to range between 120 to 190. He is saying that, okay, I entered an agreement of 150. However, price may go from, between the range of 120 to 190. The expected price of X Limited and its probability is given below. Expected price is 120, 140, 160, 180, and 190. Probability of expectation of 120 share price is 0.05. That much only I can expect by after 4 months. I can the 120 market price of 120 will be very, very, very less. What very less? It is only a 5%. I can think the market on that particular 4 month later, this share can be sold in the market for 120 rupees only to the extent of 0.5. His own understanding, he is predicting like that. And he is also thinking that 140 rupees will be maximum of 20%. 140 rupees market price would be maximum of 20%. Then what would be the 160 scenario? He is thinking most of the possibility comes only 160 rupees. What is thinking? 160 rupees will be 0.5. Then 180 rupees again 10% probability is there, and 190 rupees 15% probability is there. He is predicting like this way. So now the questions are like this. Compute the value of expected share price at the end of the 4 month. What is the expected price of the shares after 1 month, 4 months later? If you are thinking there is a range of 120 to 190, and also you are thinking there are the probabilities which may come like this way. The prices of each segment will be appearance of the 4th month later is only this much. So what would be the expected market price on the 4 month end of the 4 month? That we need to work out. Then the next one is, can you mute someone? Okay, so you are able to see the questions. You are able to understand what the question is asked. Okay, the options questions will be like this. 1 minute. Compute the value of the call options at the end of the 4 month if the exercise price is prevails. And then third one is, if in case the option price is held to its maturity, what will be the expected value of the call option? These are the 3 questions. Each question carries 2 marks. This is an exam questions. Each question carries 2 marks. This kind of questions only will be there in the exam. So now we'll go, before going to this, we will understand and we'll make a note of what are the points given in this question. It is a 4-month call option. You can take a pen and paper, whatever, you can make a note of each question's contents, what is there for the question. One is, it is a 4-month call option. Second one is, face value is only 10 rupees. Face value is 10 rupees. Exercise price, value of exercise agreed price or exercise price is 150 rupees. I am agreed to buy 150 rupees. Then Mahadev is expected range is 120. That range also he has given 120 to 190 in probability. So let us solve this problem. Let me take Excel of this one. My Excel is visible?
No, sir.
Okay.
No, sir.
Not visible?
No.
No, sir.
Now?
Yeah, it's visible now.
Yeah. Before I'm going to solve this problem, I am going to show you the live market updations, how the market will be. I'm just wait, I will show you the market. Hope everybody already knows about the market, how the market, you can just try. This is the Nifty market, how NSE Nifty, just how I'm just opened. This is our online market information only. How call options, how the in the money, out the money, out of the money, what is this concept, how it works. This is the Nifty 50. Okay, this is Nifty 50, and currently Nifty 50 is selling at what? 11,642 is a spot price. You understand? This is a spot price. You're able to see my screen, right? Okay. This is a spot price. So now you can see the same underlying asset. For the same asset, there are so many buyers, so many sellers. That is why there will be so many call options holders and respectively say so many put option holders also will be there in the market. This is a live market. Just now I have taken November. Okay, expected date is November 2. This is normal date thing. The when it is going to complete, this call is going to exercise on third of the November. Trading date is 3rd of November or 5th of expiry date is 5th of November. It is going to expected to expiry by 5th of the November. If I am a, this is a product, you should think like a share. This is a share. Nifty 50 is a share. My share price would be, today's spot price is 11,642 is a today's share spot price. My strike price or exercise price would be whatever. If I am a bullish, I will think my expected future next month it will be around 12,550. So I will buy so many calls and I will pay so many premium. That way, and if the person who are see the in the money, out the money, what is that? In the money, out of the money, at the money. Anything is between the spot price. Anything is between the spot price is called in the money, out of the money. This year only it lies. When it comes to put option or call option, it is already out of the money. That is why no people are subscribing much for this particular area. See, 900 call options. Who will buy? Only bullish person will buy. That guy will not think market will fall in future. On 5th of November, market will not come down to 9,300. He will think like that way. That is why he will never purchase any of the calls. You're getting? However, he will purchase only on 5th of November. I expects this is the market price. This is the market price. That is why see all range between purchasing calls only when spot price more than spot price only all are trying to that too, especially in this particular zone only everybody is willing to play the call option model. The same way opposite for the put option holder, where he will think the market may fall in future bearish way. That is why he see so many subscriptions are happen only these range, whereas zero subscriptions will be there or very minimum subscriptions will be there in the market. So here in the money, out of the money is 11,600, 11,642 as today's spot. This will be the in the money and out of the money area. So let us go with the problems now. Neat. We'll take like this. Mahadev is having 4 months call option. Correct. Face value of the call is face value of share.
The Excel is not visible to us.
Not visible.
The Excel on which you are working.
It is not visible. Huh? Okay, 1 minute. Now is it visible?
Yes, sir.
Okay. So we will make it zoom it. Hope it is visible to all of you. Mahadev. Dev. Mahadev case. 4-month call option having face value of share is 100. Face value is 10. Only 10 rupees is a face value of the shares. What is the exercise price? He entered is 150 rupees. And what is the range he is expecting?
120.
Range
120 to 190.
120. Correct. 190. This is the range he is expecting. Let us have a expected market price is 120, 140, 160 and 180. These are the range of expected market price. And then for probabilities 0.05, probability of expectation is 0.05, and then next is 0.2, 0.20, 0.50, 0.10, and then 0.15. This is the expectations are there. Then what is our question is, this problem is we have to share the question again and again differently.
Value of expected share price at the end of 4 months.
The question is like that only, right? Question is this: compute the value of expected share price at the end of the 4th month. That is what we need to select now. We will calculate whatever is there. So expected market price. This is market price. We'll take it as market price, and expected market price would be this into this. What is the expected market price? 160 rupees is what I most probably expect. This might be the answer. This may be the my expected price in future. That is what is going to Mahadev is expecting. Maximum I can get if all the scenario comes, my maximum expectation would be 160 rupees. This is answer for the first question. See, answer is C. Expected price per share at the end of the 4th month is 160.50. Then compute the call option at the end of the 4th month if exercise price prevails. It means what? Exercise price prevails. He says if the exercise price is there, no, whatever we worked out, entered, agreed, that will be the price. Exercise price prevails. Exercise price is 150 and expected market price is also become same 150. That is the same market price. Then the value of the call will be what? When market price and exercise price is same.
Zero.
Yes, exactly. The market price will be the call value of the call will become 0. This is the answer that carries a 2 marks for you. This carries a 2 marks for you. 0 carries 2 marks. Option is B. Then the third one is, in case the option is held to its maturity, what will be the expected value of the call option? So till maturity, the this particular call option is kept. Then what will be our expected call option? That only we need to work out. That will be work out like this. Now we will take the same. This is the market price on the future market price. The probability is expected this way, and exercise price is 150 for all the cases. And whether you will opt the option or exercise the option, yes or no?
No.
No. Okay. When market price is 120 and agreed price is 150, will you accept this agreement?
No.
No. Exactly. So no. And if it is 140,
No.
160,
Yes.
Yes.
to the extent what is interest, yes, you will exercise, right? Then here also,
Yes.
correct. And here also same.
Yes.
Here also same. Then what is intrinsic value? Intrinsic value is the value between the spot price to exercise, difference between the spot price to exercise price. What is spot price here? 120. Exercise price is 150. The intrinsic value is how much? Huh?
0.
Exactly. Perfect. Because I'm not going to exercise it. The call is going to become lapse. So the value of the call is become 0. The intrinsic value also become 0. There is no minus. Entire option concept, there is no minus value for the options because it is only an option. You have no obligation to go and buy when it is a negative. When it is comes to 160 and the market price is exercise price is 150, this intrinsic value will become 10. You got it right? This concept you are able to understand?
Yes, sir.
Very good. So option is not a big deal. You can easily understand. Initially we'll go with this kind of problems. 150 to 180, 30 rupees you are going to gain, and here 40 rupees you are going to gain. What is the probability of gaining this much? What would be the probability of gaining this call? This is the question now. Question is, what is the probability? Probable call value. Call value will be 0, 0. How much? Correct. Maximum, my probability on that day it appears is only 50%. So if at all that 50% comes, my probability is 5 rupees of my call value, and 3 rupees and 6 rupees. What would be the answer? 14 rupees is my expected. If the option is kept till maturity, the value of the call option become value of the call will become 14 rupees. That is what this is also carries 2 marks. Each whatever we solved is 2 marks questions. Answer is C. Answer is C. So have you ever felt this is a tough question?
No, sir.
And options, what will you say? Option is tough or easy?
So far, easy.
As of now, it is
As
easy,
of now,
sir.
it is easy. Very good. That's fine. So this problem, you are able to understand it. We will understand. This is also one of the famous exam question with same questions are repeating again and again. No need to go. Let's see. We'll understand first. As we discussed, there are three options. One is European option, European model option, American options, and Bermudian options. There are so many, but these three are majorly played in the market. What is American option? Anybody knows aware about it?
We can
Any
access.
date we can exercise it.
Exactly. See what we discussed. Call option means options means there will be a holder, there will be a writer, and there will be a one particular day. On that day, the price will think what will be the price. Based on that, we'll take a call. That is called a European option because there will be a specified date for option. Whereas somebody can mute that. Yes. See, whereas in American option, once you enter into the agreed agreement, call option pricing, anytime which is favorable to the option holder. I told you, on that in the European call option, only on the specified day, if that day is favorable to the holder, then he can exercise, otherwise he can lapse. Whereas in American call is not like that. If once I entered any day, if I am getting a favorable scenario, I can immediately exercise that option. That is called American. Whereas Bermudan option is like this. It is several specified dates. Several specified dates. It is a combination, hybrid. Neither it is a specified nor it is a anytime. It will be given before, say today, next month, as we agree, we discussed earlier one case. Today's spot price is 100 and we are planning to take a 1 month call option. Before to 1 month, how many weeks comes? Every Friday is our exercise days. 4 Fridays comes means 4 is exercise day. You can opt on that particular one Friday. If my price is reached to 120, immediately I can go and exercise this. I no need to wait for next 1 month to gain that. Whereas in European call is not like that. Even you are entered for only the next month, same day, 1 month call option, only you are waiting for that particular day to come for favorable to me. Whereas in Bermudian option, every week you can see and review, yes, this option will be like this. Which option allows a trader to exercise his option on any several specified dates before exercise? Which one?
Bermudian option.
Hello?
B.
Correct.
Bermudan options.
Yes, answer is B. Then I told
सर वॉइस नहीं आ रही है.
you binomial BSM, Black and Scholes Merton model, then is binomial method, then Monte Carlo method. So binomial option pricing method is most probably into arithmetical calculations. There are two probabilities are expected. This is the formula to note it down. Before going to this formula based calculation, we will go understand the concept and then we'll go to the problems. Then pointers you can understand. American options can be exercised at any time. What is option pricing? Option pricing is consist of two values already discussed by sir. Maybe I'll try to refresh very fastly. Intrinsic value and time value of money is consist these two. If these two factors are considered, then the option pricing will come into the picture. What is intrinsic value? Already I discussed. Spot price to strike price we are comparing, that is called intrinsic value. In case of call option, we are comparing spot price, what is future price and what is today's price. Whereas in case of put option, we are comparing price and what would be the future price. That is the only difference. You can compare and understand what is the intrinsic value. And then what is time value of money? Time value of money is a time to maturity. I have to wait for 1 month. That is the time value. 1 month. If I am investing this somewhere, what would be my gain? That is time value of money. And volatility, the risk of changing any factors, also be considered while pricing the options. And rate of interest. If I'm invested somewhere, what would be the rate I would have gained? That these factors will be considered while analyzing the price. That is what the theory here. But you need to make a note of these two factors alone, because these two are very much exam oriented questions. They will ask you, what if the call option comes, what is the intrinsic value? If the call option comes, what is the intrinsic value? Current spot price minus strike price. Whereas if it is a put option, strike price minus current price or spot price. You just make a note of this. Then time value money we already understood. Then you can answer for this. Intrinsic value in case of a put option. What will be the intrinsic value in case of put option? What we discussed just now. Strike price
minus current.
Correct. Strike minus price.
Current stock.
Exercise price minus spot price. So strike minus current. So option is A. So we'll go with the answer. Before that, we'll solve this problem. Can you read this problem?
A stock index is at 5,000 points. There is a 50% probability that it will change either up by 20 points or down by 10 points in each month. Consider a European call option on this index with the exercise price of 50.20, which will expire in 3 months.
Correct. So this is the given data. We will note like this. Stock index. This is very well known problem. Any of the people who are appear the examination, they will index problem, they will understand index problem, because this is a tree method. This problem can be solved only by tree valuation, a binomial tree method, because there is no interest is given in the formula. If you want to go and solve through the formula, you need to have a interest rate, whereas here this is very specific kind of scenario where stock index is given 5,000 points, and that is what I explained today. I shown the NSE Nifty, right? What was the point? 11,642 was the point, right? But in this question, the stock index is 5,000, and there is a probability of 50%. It may either way changes. What way? Either it may go up 20 points more or come down 5,000. That is the probability. Considering the European call option, means we are going to stick to the exercise date, European call option, not on the every day, every month we can exercise it. No, it is only European call. At the end of the particular specified month only we can take a call. So considering the European call option on this index with the exercise price of 5,020, which will expire in 3 months. So it means we will make a note of it. Index value is 5,000. Just make a note of it. And probability of going down or up is 50% on each month. And what is the points which may go up by 20 points? It may go down by 10 points. Just make a note of it. We'll go to the solution. Okay. Then what is exercise price? What is exercise price? 5,020. this is what the agreed price I'm going to on next end of the third month. I will be buying this 5020. That is agreed price. Today's price is 5,000 and expected probability is 50%. And expected come down or up, going up is 20 and 10 points accordingly. So find the value of European call option. Find the value of European call option. You're able to see my screen? Hello.
Question 1 is there, sir.
Yeah, perfect. So the second one is, if the actual price of the call options were
12. What
And third one is, if the anyone having question? Somebody is asking some question?
No, sir.
No, right? Yeah. So these are the 3 questions. Each question carries 2 marks. Each question carries 2 marks. We will solve how to solve this problem. We'll see. Now we'll go. This is a binomial tree method. We will solve this one by Excel. Actually, if it is pen and paper, it will be easy to draw the things. But we'll go with the Excel alone. How to solve this? How to draw the tree in the Excel? You're able to see my Excel?
Yeah.
Yes, sir.
Okay. Tree option, tree model, whatever. So now what is given data is index, spot price, $5,000. Correct, spot is 5,000. Probability is 50% on each month per month. Next is what they given, Dow up points. It may go up by 20 points. Correct. Down points.
10 points.
Down by how many? 10 points, right?
10 points.
Okay. Then what is given? Exercise price also is given, right? 5020. This is the data is given, and is asking what is the expected price on the call option. Let us solve like this. Here is a spot price, 5,000. This is actually tree. I'm going to draw tree in Excel. I try to minimize it also very slow, because it has to be cover, tree has to cover here. You're able to see screen?
Yes, sir.
Very good. Visible, right?
Yes, sir. Yes.
Very good. So we will draw like this. Month 1, 2. This is exam question. Huh? Month 3. So what is up? It will go by how many points up? 20 points. Correct? Yes. So we will take entire screen as this way, so that it will be good to visible. And also it may go down by
10 points.
10 points. So if it goes by end of the first month, if it is reaches to 20 points, what will be the result?
5020.
Exactly. And if it comes down by 10 points, what will be the answer?
4990.
4990 is the answer. This is the probability on price may come. Now, on the second, on the next month, again there will be a probability of going 20%, 20 points up and 10 points down in each category of probability. Now, if 520 become added to 20, what will be the price?
5040.
Correct. This is expected value. And 5010.
5010.
Correct. Here also
4970. No, 5010.
here also 5010 and 4080.
4980.
Sorry, 4980. This will be the probabilities of next month. At the end of the second month, we can expect this might be the probability. At the end of the third month, what will be the probability? We will see. 20. Again, it may come down to 10. Again, here also same 20 and 10. 20, 10, 20 and 10. This maximum probability we can expect. So what will be the on month of the, what will be the probability?
5060.
I don't want you to make a tough on the valuation. It is very easy. Option valuation can be easily made. Okay. And then what will be the year added? 5030. Yeah, 5030.
5000.
1000. Correct? Yeah.
4990.
30. These are the probability may come.
Okay,
5000. End of the method. 5000 and 4000.
970.
970. This is the maximum probabilities may occur after third month. Third month of now I will put what is exercise price. 50. Correct. Correct. Very easy method to understand. That's why I'm taking very easily. Answer I'm making it very easy because you should not feel that option is tough. Option is very easy. This is exam kind of question only. All exam questions. You can directly take practice board exam. What is intrinsic value? Can anyone tell intrinsic value? What is intrinsic value? Intrinsic value is
Strike minus current
40 rupees.
exactly. What is the price? What is the value?
40.
40.
Here
10.
correct. Then
10 minus 20.
huh?
0.
There is no concept of minus. Never use minus. So next one is
0. No, 10 rupees.
10.
very. And here 0. And then
0.
0 also.
0.
So this is the expected my intrinsic value. My intrinsic value will be this much. Then what is the probability I will think month M3, M2, and M1. My probability of expectation is every month is 50%. Correct? Every month this may go up by probability of going up or down is only 50% extent. So I will apply that probability of 50% to intrinsic value to arrive the final value. So 40% on the 50%, 40 rupees into 50% is 20. Correct? And then same 20 rupees in the next month of month 2, what would be my probability? Getting 20 rupees is again possibility is only 10. And on the last, then the present value of the present month, my expected probability is only 50% of getting 10, so 5 rupees. This is the total here. 5, 2.5. You are able to get this how I am getting 2.5?
Yeah, 1.2.
Yes, yes. 1.25. Many people are not understood this. I used to I believe it or not, this problem, many people are failed because of this problem. Because they are not able to apply their mind in the examination. It is too, they feel so tough, and they used to come and ask how this, that. So that is how every night they used to call me and ask me how this, because this is how they have to apply the mind here. The application of 50%, 50%, and 50% on each month of probability. That is how we have taken, no, probability of going up, going down, going up, going down. Every month we are applying the probability of going up. Same way we are taking what will be the call value if it access. So now what on the month of today's month value? All other cases is 0. It is 0. Correct? In all other cases it is 0 only, right? Any doubt?
No, that's fine.
It is clear. That's all. So my total value of the call is becoming how much? How much?
8.75.
8.75 is the value of the call option. What is the question here? This it is the problem sharing this. Okay, so what would be the find the value of European call option? What is the European call option? 8.75. We got the answer. 8.75 is the answer. C, option C. Then, if the actual price of the call were 12, what strategy you would adopt? See, you are a valuer now, registered valuer, and you are applying this concept to your client. One of your client asking you to value the call. So you are planning to value this option. So you gone, you applied all the probabilities, you arrived at the 8.75. However, the same call is selling in the market for 12 rupees. Same call is selling in the market for 12 rupees. What suggestion will you give to your client?
Sell the call.
Undervalued by.
Because this is a 2 marks question. Huh? The 2 marks question. Whatever you would decide is the 2 marks you are going to get. I am telling you 2 marks question. Be careful to understand the concept, because I have seen minimum 10 to 12 members are shared their answer sheet showing
The price of the call.
59.75. 59.75 is the answer result they got. 0.25 they are unable to get the score.
Overvalued sell.
Sell. Overvalued sell.
Sell.
Exactly. See,
Undervalued sell.
my product is worth only rupees. Can somebody move that? Yeah. My product, I know as a valuer, I am the registered valuer. I know how to value the call. So I valued it is only 8.75 rupees only the worth. However, in the market, it is blindly. They don't know the valuation, how to do the valuation. Just like that, they are selling at 12 rupees. It means this product is overvalued. You should not always think, because many people are confused. It is undervalued sell, undervalued sell. No, it is over. Market is over. You always think market is only variable way. Your valuation of worth, identifying the worth of the product, is a stagnant. You are already identified as a registered valuer. You know how to value the option. So you valued and you identified 8.75 is the right answer, right worth of this product. However, market is blindly selling at 12 rupees. It means what? Market is overvalued. What you have to do immediately, you are advising your client to go and sell it immediately, because market simply the worth is only 8.75 rupees. They are selling at 12 rupees. Go and sell immediately, get the profit. That is how you will advise. Correct or not? I'm not able to see you guys. Correct,
Yes, sir.
right?
Correct, sir. Correct.
Yes. You are able to understand this concept. So when the market price is 12 rupees, you have to, it is overvalued,
Overvalued and sell it.
and sell. Exactly. The same scenario, again 2 marks question. This is again 2 marks. If the price of the call is 6 rupees, the price of the call is 6 rupees, selling in the market, actual price, whereas your worth of the product is how much?
8.75.
Exactly,
Undervalued by.
8.75. Blindly they are selling at 6 rupees. What advice you will give to your client?
Buy.
Undervalued. Market is very much undervalued your product worth. Go and immediately buy that. That is the answer. Undervalued, buy. You got it? So this is the answer you are getting for 6 marks question. This one. So probability of getting 20 marks is, out of the practical cases, is easy. Correct or not?
Yes.
Yes. So you need to get 20 marks from this. Balance 40 you can try with the 80 marks theory question. Okay. 55% minimum you need to get. Then only you are able to clear the theory portion. You need to at least out of 80, minimum 55% you need to gain the theory. The balance 20 marks you need to straight away take from this practical. Then your score will be 60 plus. Okay. So we'll go to the next problem. Next problem is valuation of put option. Can you again, somebody has to read this problem so that we'll go to the solution.
A stock index is at 5,000 points. There is a 50% probability that it will change either up by 20 points or down by 10 points in each month. Consider a European put option on this index with an exercise price of 5020, which will expire in 3 months.
What difference you found in this problem to earlier
This is
problem?
put option.
Exactly. Otherwise, the wording line by line English is same to same. See, same and same. That only this exactly. Only thing is put option. This either in the examination, either this will be asked or that will be asked. Value of the call option will be sometime asking, or put option will be sometime asking. You need to be understand what is the difference in these two while solving the problem. Let us go to the problem solution. We'll go to that. So this you understood?
Yes.
This tree you understood? This is the tree begins here, spot, and then go to future prices, and then will reach it. It looks like a tree, like this tree. So it is called tree model. Okay. Let us take same, copy paste it in other place, and then we'll solve that problem also. Same data is same, whereas here I need to put tree call option activity. Now, do you want me to write again the same tree, or it is fine that you are able to understand how to draw the tree?
The tree is fine. Only we need to change this
Concept only I need to
intrinsic
explain,
value.
right?
Yes.
No need to repeat the tree again. Do you want again to repeat this one?
No, sir. No, sir.
Not required, right? So now let us go with the same. I will just explain the tree again so that it will be there in your mind when you are planning, working out yourself. The spot price is 5,000. It may go up to 20 rupees up and 10 rupees down, whereby we reach at the end of the month, first month 5020 and the same numbers. Again, the probabilities will come. Again, the price will be added up to that extent. The same way we arrived what would be the expected price at the end of the third month. We comes to know 5060 is the third month value, and all other numbers are resembled to the same. Now, exercise price is also same 5020. 5020 only is the exercise price. Now we will understand what is intrinsic value when you are opting for put option. When you are opting for put option. If I am a put option holder, you understand what is the put option? Put option means you have right to sell.
To sell.
What you have right to sell? You have right to sell. When you are having a right to sell, when you wish to sell,
When
when
the market is high,
right,
the price is more.
Huh?
Strike
When
price is higher than
Price
the
price is
current
more.
stock price.
can somebody tell this correctly?
So
Spot
strike
price
price
is
is
when
One by
spot
one you tell, one by one, because this is very interesting. Need to tell this.
when spot price is less than the strike price, then we'll exercise the option, put option.
strike
When the
price is
market
higher
When the
than
strike price
can
is
be-
more than spot price.
This confusion is there. That's why I'm asking you to tell.
Both are
See,
correct.
let us be out of the confusion. We will understand. You have right to sell when you are having right, and when you are having a right, you are always think which is favorable to me. Correct? You are having always right to think about your favorability. That is called right to think. Right to get an option. Now market is selling at 5060. You are agreed to sell for 520. Which one you will go for a person to search? Where is that agreed party? Come here. I will sell to you 5020. Or you will go directly into the market and throw to the market by getting 60 rupees. Correct. Which one will you do? If you are having an option, you will search that party to agreed party. Come here. I will sell to you only for 5020. Will you do that?
No, sir, no.
No, you will go directly to the market and you will sell that in the market because you are having right to sell. There is no obligation to sell. You have right to sell. That is why you are not exercising this option. Intrinsic value become zero because you are lapsing this option. You are lapsing this option. So here, what is the next option? Next to intrinsic value?
Zero.
Again zero, because market is higher there. Why should I go and search agreed party to come and buy my product? And I am directly I can sell in the market. Right here,
Zero.
again zero. Next,
20.
the 20.
here comes to the 20. I will search for that party. Where is that guy? Come here. Market price is only 5,000. I am ready to sell you for 5,020 as agreed. Here also zero. Correct. Here 20 I am going to get. Here I'm going to get again 20. Yes, here I'm going to get 50 rupees. I'm going to gain. Correct? This is the probabilities. Now probabilities for this zero is always zero. Just mention it. And now what would be the probability of 50% on the third month? 10 rupees.
10.
Correct? And 5 rupees on the next 50%. And point
The 2.5.
2.5.
same will apply. The same probabilities can be applied for all the 20 places. Correct? And what is the year?
25.
25.
Correct. See, you people are not answering. No worries. Answer is came.
6.5.
And
6.4.
6 point?
6.25.
Exactly. Perfect. So what is the option price? Put option price is?
13.75.
So answer is over. Put option price is 13.75.
75.
Can somebody can answer for this now? Where we are now? Where we are now? Put option. Put option. Yes. So what is the find the value of European put option?
D.
Answer is D. Tell me if the actual price of the put options were 11 rupees. What will you do? Be careful and understand and explain me. How will you take this situation? You are going to advise to your client as a registered valuer. You are going to advise your client what action you need to do. That is a call option.
Undervalued buy.
Undervalued.
Undervalued buy.
Even in the put option also.
Yes.
Are you sure?
Put option to be
So because the worth is 13.75, which is higher, and if the actual price is 11, which is less, so when it is less, that means it is undervalued, and in that case, we need to buy.
Very, very perfect, because very normal economic concept only we need to apply, where you need to say it is neither put. See, in all other except these scenarios, in all other scenario, call is opposite to put options is always opposite to call option. Now only we see no that wherever we exercise, there we are relapsed. Where we relapsed, there we were exercised. You understood the tree? You understood the tree, right?
right.
Yeah, when we are options call option which we exercised in the put option, it become not exercise. So it means what? Put and call always goes with the opposite direction. However, when you are finally going to sell and buy, your normal economic rule, law of economics always works here. So when the market is sells for 11 rupees and you are having a product worth of rupees 13.75, you will tell it is undervalued. Go and buy.
Right.
Go and buy to your client, then you will make a profit accordingly. Then what is if the actual price of the put options were 18 rupees, what strategy you will advise to your client?
Overvalued.
Overvalued. Overvalued. Market is blindly selling 18 rupees, but actual worth is only 13.75. You go and sell yourself your product and then get the profit out of it. This is the total problem, carries 6 marks. So next, you will understand put call parity. What is put call parity? On one point of time, total call, always call and put goes in a opposite direction. However, in some point, it is synchronizes. It is equals to the call option. Put option is always equal to call option only when put call parity works. That is a formula. You can note it down. It is visible means fine. Otherwise, I will make it big screen. Is visible?
Visible.
Yeah. Please make a note of this formula. Is it class boring? It is tough. Feeling like tough?
No, sir. No,
It's
sir.
fine. It's good.
Hope you already noted this one. Put call parity. C means call premium plus present value of exercise price equal to put value, put options ka premium plus spot price. If this works, then the put call. This is also 2 marks question or 1 marks question may ask come. So
S is
Current price of the underlying.
You're able to see, right?
S is underline meant to be
What is it?
the last S, the current price of the underline.
That is nothing but the underlying product. What is the spot value of that particular product?
Okay.
Always they named it as underlined asset or underlying asset. Okay, got it.
G.
So let us go to the problem solution for this. Can somebody read this and understand the thing?
Victoria's stock price is currently rupees 20.
Correct.
6-month call option on the stock with an exercise price of rupees 12 has a value of rupees 9.43. Do calculate the price of an equivalent put option if the 6-month risk-free interest rate is 5% periodic rate.
Exactly. So periodic rate, we will take a data out of this particular problem. We will understand first. Victoria stock price we are going to understand. Currently selling at 20. Means
20.
what? Spot.
Stock
Is how
price.
much? 20. Correct. This is a 6-month call option. Let's mark it out, that one. 6-month call option. And 6 month is considered as one period. One period.
1 period.
1 period. 6 months is considered as 1 period. What is exercise price?
12 rupees.
Selling price.
Exercise price is how much? 12 rupees.
12.
Correct. And what is the premium? Call premium. It is selling. The exercise price of 12 rupees agreement is selling in the market for 9 rupees.
9.43.
43 rupees is a call premium. Call premium. Calculate the price of an equivalent put option if the 6-month risk-free interest rate is 5% or small r is 5% for the particular period.
Sir,
So,
elaborate call premium once again.
yeah, call premium is what the person, say for example, the same problem will go again. Today's price is 100 rupees. The share is selling. I am expecting to sell it tomorrow. By the same day of the next month will be 110. I am agreeing with you. Let us get into the option price contract. I want to buy this particular share on the next month for 110 rupees. You think you are the seller of that particular writer of that particular call. You think, okay, sir, Bhushan, I can sell you the 110 rupees on the day, irrespective of the market price. Even if it goes to 120 also, I am ready to sell you at how much? 110.
110.
Correct.
Yeah.
So for that, what benefit? See, if it goes to 120, you will gain the, as a holder, you will gain 10 rupees. Correct?
10 rupees.
Correct. If
Yeah.
it goes to 120, I am the loser for rupees 10 rupees.
10
For
rupees.
that, I want some benefit,
Right.
commercial benefit. For that only, he is, while entering an agreement with the writer, he is expecting some amount of token amount is called call premium.
Okay.
Call premium. Say exercise price of this particular call. Currently it is selling at 20 rupees. Okay. And they are agreeing to sell for 12 rupees after the 6 months. It
Okay.
may go to 30 also. Who knows? 30 also. It may go after 6 months. Who knows, the scenario comes better. It to go to 50 also. But I am ready to sell at 12 rupees. Okay. That way, for that, you need to give me some commercial compensation. That is called call premium.
Okay.
Okay. This is the value of the call premium. If you give this one, I am ready to enter an agreement between you, with you. If you give me 9 rupees 43 paise, I am ready to enter agreement. On the day of the 6th month, I am ready to sell you at 12 rupees, irrespective of market price. That is the agreement price.
9.43 rupees would be in addition to the value that would be on the exercise date.
No, it is an initial token amount. It is an initial commercial token amount given to the writer, because writer is an obligator. He has to do the act whatever holder says. On 6th month, if the price is going to become 50 rupees, current price is 20, after 6 months it become 50, then I'm having right to buy from you for 12 rupees, but that guy is loser on that day. So to compensate that, he is today itself he is collecting 9 rupees 43 paise. Say that because he is a bearish, he thinks always the market may come down to 8 rupees after 6 months, it may come to 6 rupees. He will think like that. That is why he is willing to enter an agreement after 6 months. Maximum it may reach to 12 rupees only. So now I am able to get the 9 rupees 43 paise as a one of the token amount as a
Yeah,
premium.
as you stated that suppose if the price after 6 months goes up by 30 rupees, that is 50. In that case also, he will be taking money, but he doesn't know it whether what will happen after 6 months. But would he be sharing any profit or just the commission?
No, nothing.
No,
Only
no
whatever is
profits.
entered in the initial stage by paying the 9 rupees 43 paise is end. That's it.
So, on
It has
what kinds of product do we go for put call parity? Why not all the underwriters go for this then?
what kind of
Product do we go for put call parity? Like I'm asking that every time there is a risk for the writer when they enter
see,
into
when
such
there is a
options.
you are having a duality in your mind that you are taking a two strategies. One is I'm thinking this company may go up by extreme because of so and so scenarios. You will note it down some 10 scenarios. Because of the prime minister may change, a government may come differently because of the election is coming in favor of this. That there's so many economical factor, external factors will consider, and you will think this company grow with a high level and it may reach to 50 rupees. And also one more back mind says that if that particular government is not come, this guy will not get the much better market. So it may suddenly, if the other party has come to the power, there's other guy will go down. Thereby, the market may go. Suddenly, you will take a strategy of that is called straddle strategy. This is also exam question. Straddle strategy. What is straddle? Straddle, strangle, butterfly. These strategies will be covered in theory only. Okay, here problematic only will go, but still I will explain you. What is straddle is when you will buy call of 1,000 shares for the call option with the same strike price with the same of this one, and again you will go with the put option to sell the same 1,000 rupees with the same strike price, same exercise the premium. Thereby, at the end of the 6th month, you will not lose anything. But if the scenario works differently, you will gain the market. That is why put call parity, they will work out in the straddle strategies, straddle and butterflies things. Okay. Let us see how these things are working here. Let's go. Shall we solve this problem?
Yes, sir.
Yes, sir.
Yes,
Yeah.
sir.
Now, what is the formula? Can you tell me? C plus
C plus X
C raised to
E
the power
to the
minus
power.
the size. That's fine. We will write it like easy language. That is only for mathematicians. We will write it like this.
present value of
Measurement
strike
value of exercise
strike
price.
price.
That's it. Is equal to what?
What premium?
Premium of put option.
Option.
Okay.
Current price of
Plus
spot.
spot price. That's it. We will solve this equation. Your answer is ready. This also premium.
Call option.
Got it. This is the easiest formula. Just remember like this. Premium of call option plus present value of the exercise price is always equal to premium of put option plus spot prices. So in the given case, what is given, spot price is given. How much? 20, correct?
Yes, sir.
Then exercise price is also given. How much? 12 rupees.
12.
Call premium is given.
Right.
9.43.
9.43.
43.
Correct. Put premium, you know. We don't know. Correct?
Oh,
So
okay.
that only we will identify by this, putting this one into the formula, immediately we will get the answer. That's it. So what is the present value of
Present
exercise
value.
price we are given? We knows. What is the present value of exercise price? What R is given? Correct?
5%. Yeah.
Rate of interest is given for 5%. Let us identify what is the factor.
Time.
Yeah, value, present value of PV of exercise price. What is that? This, let us take 12 divided by 1 plus, you know the formula, right? 1 plus R to the power of n. N is here 1. So what is the answer? I will better write it better in before that.
1.05.
Before going to this,
12 divided by
I'm writing here.
1.05.
So formula for PV. The formula is what? 1 plus
11.44.
Exercise price divided
1 plus 1 minus 1 divided by 1
1.05.
plus R
0.05.
to the power of n. This is the formula. Okay, this is the formula. So we identify the present value. Suddenly we applied the present value for 12 rupees. So 12 rupees present value identified. This is the, now let us put the answer into this. So what is premium, call premium?
or premium is 9.43.
Plus present, plus,
11.43
correct, plus equal to,
Minus 20.
let us this, and then now 20 rupees is already
The
there,
spot price.
spot price, correct?
Right.
Spot price, put price is not there, so we are going to take a for spot price. We don't know difference between this equal to answer. What is the price of the put option? Premium 0.86, correct? When you are reading the problem, you will get confused, but when you are solving it, it is easy. This is the exam question. If it comes to the exam, there are so many factors which are visible, how to apply, but it is very simple if you know the formula. The answer is
0.86.
0.86. You got it, right? Let us go to the next one. Yeah. Any doubt in this?
Equivalent put option का price 0.86 होगा or this is only a premium?
Only premium. If the
Here he
same
is asking the equivalent put option. So what will be the value of that put option? Will it be 0.86?
Not value, it is not value, it is a premium. They are asking what will be the option premium, put option. price of equivalent put option price is, so risk-free rate is 5% only that, because what is the meaning of it is like this. Today's market price is 20. Okay.
Right.
And after 6 months also you are willing to sell for 20 rupees only. Will you collect so much of premium? You are not going
No.
to lose anything, right?
Hmm.
It is only a probability of that if the 20 same after 6 months also I am ready to sell for, I may expect the price of 20 rupees. There will be a premium will be very, very less for the expected price. That is why it is comes under. Okay. Bermudan option we have already read. Let us go to the, what is for 4:30? Yeah, you want some break?
Sir, how to get to know that what the question is asking, because the terminology is quite confusing in this question. It's difficult to understand that they are asking for this put premium.
See, calculate the price of equivalent put option if 6-month risk-free rate is 5%. They are asking you what will be the put option price. If the put option, if I am selling today, what price I have to sell in the market? If I am ready to subscribe for the put option, it means I have to collect some premium as a writer.
Right.
That premium is only is expecting. What will be the expect? That is directly state.
This 0.86 is the premium, but like equivalent put option, what I am understanding reading this question is that what will be the price. I would come across that this will be the price after 6 months. I am going to buy at this price. That won't be 0.86. That is the premium I am paying to get that price afterwards.
Exactly.
That
That particular
Should
question
add
is,
up. It should add up. Actually, we are thinking that it should add up. Like premium is 0.86, and if the exercise price is 12, then 12 plus 0.86, 12.86 should be the answer.
no, not
No,
really.
it won't be. It won't definitely be, because 0.86 is the right now we are paying it to the writer that we are taking this option. You will compulsorily give us at this price, and you don't have any option. That is, we are taking his option, or and keeping that option with ourselves. For that, we are paying a premium. That is
Exactly.
understood.
Yes.
That is understood. For that, we are paying him a price. बट यहाँ पर जो इक्विवेलेंट पुट ऑप्शन लिख रहे हैं ना, तो उससे क्लियर नहीं हो रहा कि दैट इट इज व्हाट दे आस्किंग द पुट प्रीमियम. वो कम अक्रॉस होने में थोड़ी सी प्रॉब्लम आ रही है.
Call parity, they will ask you the question like this: put under the put call parity theory, what would be the equivalent put option? That's it.
Okay.
Okay. Thereby you will get the clarity, because they will not confuse you in the examination all.
Okay.
Yeah. Okay. So you need any break, or you can continue?
15 minutes break.
Only 1 hour is there, because I have to cover bond valuation also. I think this option you guys are able to understand maximum extent, hopefully, right?
Class is there up to 5 or 5:30, sir?
5:30, right?
5:30. Okay. Then we need some break, sir.
You need a break. Okay.
Yes, sir.
You take a break
5-10
of
minutes will do.
5 to 10 minutes. That's fine, because another 1 hour I need to cover other topic also.
Okay.
Let us directly go to the what is that bond valuation. 1 or 2 problems we'll solve what kind of examination expected. Okay.
This
Yes,
binomial option will
it is
be
covered
able
in
to
the.
do.
This also we will solve this particular problem also I need to
Yeah.
solve, because
Okay.
problem call option also, binomial call option with the formula we will solve one problem. Okay.
Okay.
So that it will be easy for you guys also when working. Okay.
Okay.
Sure. See you then.
Sure.
Bye.
Thank you.
Bye. All are there, or will you wait for some time? Purushothaman Sarji,
வணக்கம் சார்.
you were able to understand the options, right, sir?
இல்ல இன்னும் கொஞ்சம் grip வரணும்.
Okay. Slowly,
இன்னும் கொஞ்சம் grip வரணும்.
slowly it will come.
But okay, I can able to follow.
Very good, very good. That's why I'm going very slowly, though time is very short. I don't want to see my.
Thank you, sir. Thank you.
Yeah.
Class.
Once everybody is on board, try to inform me so that we'll start because we don't have time. We need to cover bond valuation also. Before going to bond, we'll complete this binomial option pricing model by formula based. Please make a note of this formula so that it will be useful to solve the problem now. This particular symbol is called delta. This particular symbol is called delta. Option delta. They will call it as option delta because in examination Sometimes they may ask only to calculate up to the delta level. So let us work fully. Let's start.
Yes, sir.
Yeah. Okay.
So just a second.
Yeah. I'm there. Though it seems very tough, it is very easy only, but you need to make a note of it and write it twice or thrice in a paper. One very clear cut advice I can from my side I can give you is make a separate king size notebook. Purchase from the market 2 books minimum. I bought it. 2 books of this lengthy papers with white notebook. Everything whatever you are reading, economics, income tax, everything has to be come in the same book, so that before examination you can go through just like this. Don't write it piece of paper or small notebook or somewhere here there and all. This 50 hours also you can write it down here. And also this, one thing I can say, this 50 hours, since you're attending first time all this syllabus after qualifying, after getting qualification of so many years back, this is the first time might be you are able to get into this particular, again brush up all your earlier studied. No worries, this will not immediately go into your mind, but this 50 hours will be helpful when before the examination, because by the time you are able to go through yourself, practice yourself, and then look back to the 50 hours class, you will understand, oh okay, this is what the importance of 50 hours. At the time of taking, many people used to ignore this 50 hours just to take after that only when I'm going to exam apply. When you are taking an examination only, you are able to get that seriousness of taking the session. Anyway, but one more advice, or I can say, because many of the people who used to interact with me, as I already told, 1,500 people who are aspirants of valuation, who are normally interact with me. I'm the only contacting person for all interaction, whoever is attending the GKR's session. Thereby,
What is your phone number, sir?
huh?
Share your mobile number.
Yeah, I'm there. I'm giving you all the options. You can call me anytime. Anytime you are having any doubts in any of the syllabus, any topic, you can reach me. Okay.
Thank you.
Take the topic. You can anytime, even midnight, 2 o'clock, you can call me, because at that time only you are able to work. Daytime you will be having fully busy with all your practicing works and all, and family and all. Normally I used to read at night only, because going to office and coming back 1 o'clock, 2 o'clock, 3 o'clock. That time you can, even if you are able to immediately want, you can call me. I don't mind about it, because we need to first get this certification. Thereafter it will go very things smooth. And most probably one more advice I just wanted to mention here, because I got it from my madam, who encouraged me to take this valuation, and she used to book me a slot. That lady, what advice is that is I'm giving to everybody. uh, and also in practical, one lady who is a chartered accountant, fully engaged, she used to take one slot in a month. Normally one slot in a month she used to take. And she asked me, sir, what is this? Last 3 months I am trying to read this only, and I am 3 attempts I given, I am unable to clear. I said, in a month they will open a slot minimum 5. Earlier and all, morning evening session you can take 2 attempts, you can immediately continuously you can take. But now, because of the COVID and non-availability of the session slots, very restricted slots are there available now. What I suggest is book a slot which is available for entire whole month. How many is there? You just book 5, book it. 6, book it. Book. Attend first, learn something. Attend second, learn something. Attend fifth, learn something. Clear sixth, and that particular month come out from this studies. Enough. Don't carry the same. You are taking the November 1 attempt, December only one you are booking 1,500 seeing, and again one attempt you are booking December. You are unable to clear because it is very tough. Concepts are very differently asked. Unexpected things are expected in the examination. So again on the January, So you are dragging how many attempts, that many attempts you need to study. That months, 3 months you need to again the same syllabus, same study, same book you need to read. You apply in the same month, 6 attempts, 7 attempts, whatever the slots available, you pay 1,500 per attempts. Let it go. First attempt or second attempt, if you clear also, don't bother. Another 4 attempts, let payment go to the government or that website. Don't bind, but you are out of the no studies in the same month itself. The same strategy is explained given to me by one of our madam. She has advised me the same thing is applied, and immediately I had left 4 attempts additionally after I'm qualifying. So that way, which helps really, because you don't expect everybody to be qualified and first go, because we are all practicing persons. We are having so many commitments, calls, and already we are engaged with the family. That is how they brought it this session also, this course also, because after 3 years of post qualification is means you are already engaged, got married, having a kid minimum at least. So thereby you will get into this course, makes this very lengthy, but try to do this. Take so as many as attempts available in the slots, and start giving. Once you appear in the examination only, you will come to know what kind of preparation is required, what is my lack of preparation, where I have to press. That is the technique. Okay, so let us go to the problem now. The problem is binomial option price model. With the formula based we will solve now. Okay, hope you are all noted this formula. Now formula is delta equal to cu minus cd divided by u minus d into s. And what is b? B is borrowings. Borrowings equal to u cd minus dcu divided by u minus d into capital R. Okay, this is the total formula for these two. Thereby the value of the call option is equal to co equal to delta of spot price plus borrowings d, whatever you are arriving this. So then what is cu? Cu is a maximum of us minus exercise price or 0. Means it cannot be minus. Maximum of 0 or this value. So it is always be 0 or the positive numbers. And what is CD? The same way. Maximum of DS minus exercise price or 0. Whichever is maximum, you take the value. That is how it says. So let us go with the what is
What is delta?
That I will explain.
Represent.
I will explain.
Okay.
Delta I will explain. Just note formula alone now. Okay.
Noted.
Yeah, that is enough. So now we'll go with the options problems we'll take now. Okay. Let us take this as a problem and note contents of this particular problem. Can somebody read it and note it down? Spot price is rupees 30. Note it. Spot is 30. Okay. Exercise price is 38. EX price is 38. Interest is equal to R. You can take it as small r. Always interest is referred as small r. This already would have been communicated in the theory session, that rho, vega, all these options already explained by this are, because that the next you can see these are all already explained. So no need to worry on that. R is always interest rate, that will be 10%. Then capital R is equal to 1 plus small r. 1 plus small r, that is nothing but 1.10. Here 10% is the interest rate. So capital R become 1.10. Correct. Next is D. Nothing but downward trend or downward trend. The swing is 0.9 is given, and U is given 1.5. Okay. Upward sign is minimum 1.5 times of. Then calculate the call option under binomial problem method. When there is a interest rate is given, you need to go only with the formula based. Okay. Let us start in Excel. Okay, I will explain you through Excel. Just make a note of the formula. Before what? 30, and then exercise price
38.
how much? 38, and then R is 10%.
10%.
Capital R is equal to 1 point.
1.1.
Then U is
D.
given 1.5.
U is given
Correct?
1.5.
And down rate is how
D.
much is given? Down percentage point.
0.9.
Exactly. This is the inputs is given. That's it, right? Let us find US. We will go very systematically, as normally DKR used to tell you, writing this template is much important than anything. Modeling, it is called modeling. So we'll try to first take template, make it visible better way. Let's see, visibility. Okay. So now we'll go. What is US? Formula requires US. So what is US? U into S. That's it. What is U? Here this. What is S? S is this. Spot rate. 45. What is DS? What is DS? Down
0.9
expected
and
price into spot price. Any difficulty in this understanding DS US? No, no.
no, no.
Okay, fine. So call option. Now, what is CU? Formula you written. Let us identify market formula. What it says is maximum of what?
US minus
US
DE. US
minus
minus E.
exercise
Exercise price.
price
Or
or
0. 0.
0.
Whichever is higher.
Correct? This is the formula. And what is, so that CU is what for us now? What is US? Let us put in the formula maximum of
45
US is what? 45
minus
minus
38.
exercise price is
38.
38, comma
What?
0, sorry, 0, close the bracket, again close the bracket, it will take you 7. Correct or not? 45 minus 38 is how much? 7.
Right.
Correct? So you identified the CU. Next, let us go to CD. What is CD? CD says maximum of CD,
CD.
CU, correct? Sorry,
CD.
US minus, sorry,
Maximum DS.
DS, sorry, DS minus exercise price or
Okay.
0, whichever is lower, whichever is higher. So let us identify the CD. What is formula? Maximum of DS is how much? 27.
27.
What is exercise price? 38.
38.
Okay, so it is the minus, correct?
It's 0.
Then put a 0. Put a formula accordingly. Put one
0.
more bracket. Hit enter. Which one is taken? Maximum of 0
0.
only. Correct?
Hmm.
So we comes to know how to arrive the CD. Now we these two factors we comes to know. Let us put like this. This formula I'll put it. Cut. So that we can save the space. Okay. Next we will understand what is delta. That delta symbol is there, no? I think I'm not able to take the delta symbol here, or it may take time. I can search somewhere and inside that delta. You try to keep the triangle, okay? Delta equal to, what is the formula? Delta formula, Cu minus
C minus CD.
CD divided by Tell me. U minus B into S. Correct or not? Any doubt in this? Formula you taken?
Yeah.
Okay. This is the formula. We are going to keep what is required in the formula. We will keep it. Delta equal to Cu is what? We have a Cu already.
1.5.
Correct. Minus CD also we have. Correct. Whole divided by will type. Whole divided by open bracket. What it says? US minus DS. Nothing but US
1.5
minus R
1.5
minus 0.9.
1.5. We can directly take
minus
reference
0.9.
also. We can directly take reference also. 1.5
0.6.
minus
0.9.
nothing but 0.6 into
38.
30.
sorry into 38. Exactly. See, you people are already becoming expert in the calculation of formula base because formula is there ready made. You can easily get. Okay. US Cu minus CD divided by U minus spot rate. I've taken a spot rate. I should take a spot rate. No, exercise rate I've taken.
Sorry, S is equal to spot
It's
rate.
30.
Ah,
It
spot
is
rate should
30.
take. No, I have taken wrongly. No, it's not correct. Right?
Hmm.
This is the delta. Delta is nothing but edging ratio. What is that? This is also one more question. Huh? You need to take delta is nothing but edge. Delta is also called as edge ratio. Delta is also called as edge ratio. What is edge ratio? Edge ratio is a always risk mitigation. Risk mitigation. You can read that all theory in theory area. Now I will tell you why this particularly borrowings comes here. You understand the steps like this. Step 1. 2, 3, 4. What these steps are? When you are having a call, when you are going to call option, when you are going to buy a call option, okay, there are 4 steps you are going to take it. What first you will buy the money, borrow the money from outside. That is called borrow first. Then buy the call option. Correct? Then sell the call option. Thereafterwards repay the money. These are the 4 steps are involved in when you are exercising the call, because as good as you are going to buy a loan from somebody and investing here. So this is actually happening in spot situation. Today's scenario, you are going to buy and invest. These two activities are happening in today's spot and sell and repay on the day of exercising. Correct? Sell and repay is on future date. So these are the 4 steps involved in. So for that only you need to identify what is borrowings. Thereby you will understand the value of the carbon. Now let us go for the borrowings equal to what is the formula for borrowings?
U into D.
UCD, correct?
Hmm.
Minus DCU whole divided by, just remember the formula, don't forget. Mug up the formula, because this is now, if you ask why the formula they kept, this is what the analysis they made it, and we can understand the plain English. We will, that also will version will come. No worry, I'll explain that. So UCD minus DCU divided by U minus D into capital R. This is the borrowing formula. So let us understand. Let us work here. UCD is how much?
UCD is 0.
1.5 into 0.
1.5 into 0.
1.5 into 0, correct? Is a 0. Let us take 1.5 into 0. Just to write, we can refer also for this one, cell directly, but I want to write it because so that you can understand easily. And what is DCU?
0.9 into 7.
Into 7. What is there given in the 7? Already we identified. So this is whole bracket closes. Now we written in numerical formula. That's it. And already we know UCD is 1.5 minus
Minus 0.9
0.9
into
close the
1.1.
bracket into what is that? 1.1. This is the total formula. What is formula given? That only we are writing in numerically. That's it. What is answer came? Minus
5.545.
5.54 is equal to B. B is equal to this much. What is call option value? Value of the call option formula.
Delta into spot price plus borrowing.
See, nice. Because memory, when you are remembering the formula, it is always easy. Delta. I will type it as delta because I can't that delta into spot. Correct? Plus borrowings. This is the formula for valuing the call option. So CO equal to what is delta?
39%.
This into what is that? Spot price 30, right? Then what? Plus borrowings. Okay. Enter. What is the value of the call option?
2.12.
That's it. Value of the call option is 2.10. Let us go to the question. Is there any toughness in this? Just to remember the formula, you are able to identify the calculation of what is the option?
2.12.
Value of the call option is 2.12. So what I can do, the same way will be there for put option also. That I don't want to repeat because the same thing only you are going to put it in the formula, put formula. Okay. So these are all already discussed. So I don't take the time for this again. Same call option, put option. What is the option delta?
Will we get the answers to all these MCQs?
Yeah, I will share you. I'll share you. Then option delta, you can reach me anytime. Okay, I'm telling you, anytime you can call me. I'll give you all these details or whatever. In addition to this, also you can call me. And what is option delta? This is also exam question. Option delta is a spread of possible shares price divided by spread of possible option prices. That is called DCU. What is that? It's a CU minus CD divided by U minus D into S. Correct? That is the formula for delta that they are asking. What is delta? This is the spread of possible. That is in English. And what is the delta ratio is called? Delta ratio is also known as edge ratio. Okay. So we all covered so many things. Volatility is always sigma. Then these inputs. What is a price? A spot price is like this. These are all you can already cover. Time means theta. T. V means vega. Volatility, vega. All Latin English. And the interest rate, no? Rate. Interest is rate. Rate means rho.
Rho.
Yeah. Sir already told this all things. So if the delta call option is 0.6, the calculate the delta of equivalent put option is -4 because put option always goes with a negativity. So -1, 0.6 minus -1 minus 1 is equal to minus 0.4 is the answer. Always this you can remember. Then relationship between the call and put option with the edge ratio. Edge ratio, how it is lies? When call option, it is always positive, 0 to 1. In put option, it is always negative,
Negative.
0 to -1. So it is what they are asking.
Positive,
Call and put
negative.
option, nothing but positive and
Positive,
negative.
negative.
That's it. See, all option itself is easy. See, we are already theories here. Put option delta is lies between so and so. Call option delta lies between so and so. Correct? That's it. You can read this. This is my contact details. You can always reach me for any kind of further classes or for further clarifications or doubts anytime. You can reach me for this. Okay. Let us go with the. Shall I close this?
Yes, sir.
Yeah. Now we'll very limited time. We'll try to close this first possible. Yeah. Screen is visible.
Yes, sir.
Yeah. We'll go to bond valuation. Will go. Now topic is bond valuation. Bond is always termed between these four terminologies. One is yield, another one is price, other one is duration and modified duration. Okay, these are the 4-5 terms will be used in bond valuation. Just keep in mind. And what is coupon? What is YTM? YTM is nothing but yield to maturity. Yield to maturity. Coupon is nothing but what interest you are gaining. What is the periodic cash flow from the bond you are getting every yearly or half yearly. Whatever you are receiving, cash inflow is called always termed as coupon. Okay. MP is nothing but market price and face value. So market price is less than the face value, then discount only will be there. Par and premium. Market price is more than the face value is called premium. When YTM is less than the coupon rate, then it is always sells at premium. When YTM is equal to yield is equal to coupon rate, then it is sells at a par. And YTM, nothing but yield is equal to coupon, then it is selling at discount. Bond is selling at discount. So interest rate and bond prices always goes in opposite direction. If the interest rate comes down, the expected interest rate comes down, the price of the bond will go up because prime coupon rates are always fixed at the initial stage of the bond. Today, as a company, I am issuing a bond. Bond is nothing but debentures. You can take it as a debenture. I am calling today to subscribe to the market 10% interest rate bond for next matured at 5 years. Maturity 5 years period. You understand very clearly. 1,000 rupees face value, 10% debenture my company is issuing today. Okay. Maturity value is 5 years. Maturity period is 5 years. However, tomorrow, just because of some other regions, after I am purchasing, after issuing this rate, my market expectation of money value is become low, where interest is becomes come down. Market value, interest become less. Even 9% also getting 9% itself is a big. Earlier you would have seen fixed deposit earlier days and all 8%, 8%, 7%, 7%. Now they are giving a fixed deposit rate is how much? 4.5, 6. Correct? Maximum 6. If you put a fixed FD, maximum 6% you can get. 4.5 to 4.9, if you number of days you are increasing, that way they are increasing the rate. When the expected rate of interest is comes down, then the debenture having a fixed coupon rate will go always, price of the particular coupon rate will go always up. You will understand once you solve the problem. That is the one. Duration is a weighted average cash flows of the total period. What is the duration I can recover the amount of my investment? What is modified duration then? Modified duration is always says how the prices are sensitive towards the yield. Once the yield is increases, how price will be decreases. When yield is decreases, how much price will be increases. That sensitivity is explained by modified duration that we are going to see in the future. Next, what is effective duration? Effective duration is a concept, mathematically calculated concept. It is only comes the questions, examination questions only will be this. This is a repetitive exam question. When effective duration is used. Effective duration is used only when embedded options are there. What is embedded options then? Embedded options means options with call. Bond issued with call, bond issued with put option. What is that, sir? Bond option, bond call. What is this? Bond is something else. Bond valuation is different and option valuation different. Whatever we learned till now is option. Now again you are coming to again option, going to again option. No, it is embedded options means what, you know? Embedded options means today I am as a company, I am issuing a debenture to the general public. To the general public, one debenture or bond value is 1,000 rupees. The value of the period of this particular bond is 10 years bond. Okay, 10 years bond. Now I will give this bond with the option that you can put, with the option of put, bond with the put option. Anytime you can sell to me. I am obligated to purchase from you. From whom? From investor. Today I am issuing a bond. Investor is willing to accept this my bond, and 10 years he is not, he is purchasing in my company bond, investing in my company. After 5 years, he is not willing to continue this particular bond with my company. He has an option to sell back to me. I don't want your bond. Give me back. That is called bond with a put option. What is bond with the call option? Bond with the call option is always with the issuer. Bond with the call option is always with the issuer, because why the issuer will issue a callable bond? Why? Because today I am issuing a bond having a coupon rate, having a coupon rate 10%. If you invest 10,000 rupees with me, 10%, 100 rupees every year I'm going to give you as interest. This is what the agreement, and I'm giving a share debentures today. However, after the 2 years later, the rate of interest become, market expected rate of interest become very less. Only 5% itself, the 1,000 rupees is not able to earn 5% of return in a year. But I, just because I committed, while issuing the bonds, I have to pay 10%, 100 rupees I have to pay to this guy. Then I feel I have right to call you back. You give me back my bond, I will take it back at a premium rate. This is called embedded option. Those time only the effective durations will be used. Just keep this in the mind. Effective duration is used in the embedded option. What is embedded options? I explained you. Call option, put option. Always call option is goes with the issuer. Put option is always goes with the favor of, who is that?
Holder.
Exactly.
Investor.
Investor. Perfect. So whatever I communicated is taken, I guess, right? You are able to follow me, right?
Yeah.
Perfect. So next we'll go to the other topic. This is a famous examination question. Let us solve this problem. Thereby you'll be able to understand it. Our data bank, examination data bank, this is there. But anyhow, whether it is there or not there, we are not concentrating on the examination point of view. But what I'm trying to say is, either of the way you are going to benefit. One is understand the concept. Other way you are going to get the same examination kind of questions. Thereby 6 marks will be there for you. Okay, let us read this problem and then we'll solve this problem. As soon as possible, because almost we are 5:30. I just wanted to complete one or two cases here in this, so that bond valuation will be grip for you guys. Hope you all read. One can read
Yeah.
this also. It's good for the others. Yeah.
Based on the credit rating of the bonds, Mr. Yignesh Desai has decided to apply for following discount rates for valuing bonds. For AAA rating, 365-day T-bill rate plus 3% spirit. For AA rating, AAA plus 2% spirit. For A rating, AAA plus 3% spirit. He is considering investing in AA rated 1000 face value bond currently selling at a price of rupees 1025.68. The bond has 5 years to maturity and the coupon rate on the bond is 15% per annum payable annually. The next interest payment is due 1 year from today and the bond is redeemable at par. Assuming the 364-day bill rate to be 9%, you are required to answer the following questions.
Perfect. This is the question. What is theme I'm going to get it from this particular question is very fastly. Note it down so that I also note, because this screen is not exchangeable screen. This way I have to close this screen only. I can open the Excel. So you also can note it down. What is this guy is Yagnesh. Yagnesh is one of the guy who wish to invest in particular bond. Okay. This guy is willing to invest double A rated bond. You know, right? What is the triple A rated bond? What is double A rated bond? What is A rated bond? What is non-rated bond? What is non-rated bond is called? What is that?
Risk
The
free
bond which is not
No,
having
no, no,
any
no.
credit
Junk,
rating at all.
junk bonds, sir.
Very good.
Junk bonds.
Excellent. This is a 1 mark question. So when there is a high risk of getting a returns, that is called junk bond, where high return, high risk. There will not be any rating at all. So this guy is willing to go with the AA rated bond, which is selling face value is what? 1,000 rupees. And currently selling is spot price or current market price. Don't use spot because spot is always go with the options. Current market price is 1025.68. Correct? And what is the number of year? 5 years. Period is 5. Coupon rate is how much? 15%. Correct?
Yeah.
15%. Yes. Annually. Paid annually per annum. The next interest payment due is only 1 year from the date of this redeem. And redeemable at par. Redeemable at par. Now, assuming 365 days, 364 days bill, government bill is selling at 9%. Why this information is given? Because he is not straight away giving the rate of interest discount rate to be followed. He is giving in a different way. One is AAA rated is T bill plus 3%, whereas AA is AAA plus 2%. So I have to apply this rule means 2% plus T bill is how much selling? 9%. 9% plus 3% is 12%. 12% plus 2% is 14%. It is nothing but directly they can give 14% selling bond. They can give like this, but they are not giving. So they are given like this. So let us take AA bond is always goes with AAA rated plus 3%, 2% spread is accepted. That is the AAA is the 364 T bill is 9% plus 3% spread is equal to 12%. Total 12% is plus 2% is equal to 14%. So we will take this as a information. Now calculate the intrinsic value of the bond. Then what is the current yield? So intrinsic value we will calculate. Then current yield you'll calculate. Then what is YTM? Yield to maturity. Then what is YTM? What is current yield? Okay. Then what is asking whether Yagnesh has to invest or not to invest. This is the question. Total how many marks? Total 8 marks question. This is how many marks? 8 marks question. Very big number. If you are getting at 52 and this marks comes easily, then you are out of the exam. So let us go with the Excel. Solve the Excel. Where is it? I open it. 1 minute. Okay. Next is what? No? Bond. Ignish bond. Is very costly. Face value 1000, and then current market price. Can somebody repeat it? 1025.6
6. Here is number of years 5.
period. Correct.
15% is the coupon rate per annum. AAA percentage is 12% and AA rating percentage is 14%.
And then redeemable. Okay. Redemption value is at par nothing but 1000, right? Redeemed at par.
That Excel sheet.
Sir, I'm not able to see Excel.
We cannot see.
Is it? Oh,
Yes, sir. We
Yes.
cannot
Whole
see
page is
that.
coming.
oh, okay. Sorry. I thought I am able to. Okay, 1 minute.
It's fine now.
Yeah, it's visible.
Visible right now?
Mhm.
Yeah.
So what is redemption?
1 minute.
Redemption.
Redemption.
Maybe I have written something wrong. Let me check.
Redemption should be.
Correct, sir. Redemption value at par is 1000.
Correct only, no?
Yeah.
Okay.
Correct, sir.
Okay. So then what else information you have taken? Triple A rated is
Triple,
12%.
12%.
9% plus
3%.
3%.
3%. You got that, no? How that 3% is comes to equal to, correct? So no need to explain again. I hope it is capturing very easily. What is double A?
12%
AAA
plus
plus
2%.
12 plus 2.
Double A plus
2%.
2%.
2%.
15%.
So double A equal to 14.
14%.
So this is the information we got it. Let us take this as a working information for us. We will immediately work out the answer. We'll get the total result. For 8 marks question mark. Let us take 3 years. Year 1, 2, 3, 4, 5. If anywhere you are feeling difficulty, just let me know. Okay. Cash flow is what? How many percentage of cash flow? Coupon rate is how much?
15% per annum.
15% per 1000 rupees. How much?
15%.
Exactly. 150 rupees I'm going to get
Yes,
every
sir.
year. Correct or not?
Yes, correct, sir.
See. And redemption is 1000 rupees and
Yes,
150 rupees I'm going to get 1150. Total at the end of the 5th year I'm going to get this much value. Correct or not?
Right, sir.
Yes. So what is the yield?
Yield is 14%.
Exactly. So 14%. 14% yield is given. So we will take a discount rate. You note it down. What is the formula for discount rate identifying in Excel? Is 1 divided by open bracket 1 plus r all to the power of n. N is what? Year.
1.
Okay. So this is the formula. Let us log this formula here. Done. Then D. So we identified what is the discount factors for these case sessions. Okay. we will apply what is PV of cash flows. What is PV of cash flows? Equal to this into equal to this. So if I'm speed very fast, please let me know. I will slow down because I want to cover one more.
Correct, sir.
Yeah, you are able to capture means it's fine. If not, you can let me know. I'll try to hold that. This is the, we got it intrinsic value. They're asking what is the intrinsic value of the bond? The present intrinsic value at this rate of interest is 1034.33. Okay, let us see the options. Again, I have to go to the options. See here. What is the intrinsic value of the bond? What is the answer?
D.
D. 1034 is the bond value. So now you will say, okay. Now we will see what is the current yield. Current is what? That is what he is asking. Always you remember current yield, yield to maturity. You need to remember. Current yield means what is the current coupon you are receiving divided by what is the price, current market price. Current coupon divided by current market price is always called as current yield. Remember, this is a 1 marks question again may come in the future, or for this for solving this 2 marks question also you need to remember this formula. Let us go with that. What is current? So what is current yield formula?
Current coupon rate.
Current coupon divided by current market price.
Yes. Coupon rate divided by current market price. That's it. Okay. So current yield equal to current coupon rate is how much, ma?
15.
Exactly. That is nothing but 150.
150.
Correct? No.
Yes, sir. 150.
Yes. So 15% is right. 15% of face value 150. So what is CMP? Current market price?
1025.68.
That is
1025.68.
perfect. So you guys are very much expert in it. See, when we are solving, it was not the case. They used to repeat again and again, only faculty. Now you guys only answering. It's good that you are able to capture. What is the answer for the current yield? 14.62. Correct. So your current yield is 14.62. Okay. However, he is chosen for 14% bond. Now that is 14%. So current yield is this much. Then what is the next question? Next question is what is YTM? What is yield to maturity? What is yield to maturity? Let us calculate the yield to maturity. If the current price is old scoot, what is yield to maturity is asking. So we will put the same formula here again. Okay. However, here I have to modify this. Nothing I modified. I'm just copy pasted that. So hopefully you all got this how we arrived these figures. Year, cash flows, discount rate, and present value of the discounted figure. So we got 1034 as a intrinsic value, current value of the bond. However, this is the 1034 rupees is the current value of the bond. However, the current market price is only 1025 rupees. Correct. So that is again understanding that concept itself will give you a 2 marks. That I will explain the last question. But now I want to check what is the current yield to maturity. For that, I need to go to use the goal seek option. Where is that goal seek option? Go to view, go to data, go to what if analysis, write down this one. This one you write it down. Write it down like this.
So please start from the way. Wow. First
I'll come. Okay. For Now we already first scenario we identified value of the bond is 34.33. Correct or not, Ma? You understood this?
Yes.
Yeah, Ma. You understood this, huh? Here we are identified, no, first beginning. With the 14% yield, I am getting 1034 rupees as a value of the bond. This extent you understood?
Yes, sir.
Perfect. However, the current market price, what is given here?
2025.66.
The market is selling at 1025 only. So I have to identify what is the YTM for that. 1025.68 is the current market price. Let us identify how that 10 today's current market price is 10, but here 134 is there. This is not the what I want. I want to calculate. So how to get that this point, how to get 1025 by changing this figure, discount factor. If I put here 10% discount rate will go to 1189. If I put 15% rate, it will come to 1000. But I want today's market price is how much? Spot price
25.
120. How can I get this 125? What is the rate would be here? I don't know. So to identify that, only we need to go to always write it down this formula because it is always helpful. Whoever is not familiar with the Excel, try to note it down. Go to data, go to what if analysis and select a goal seek option. Second option is goal seek. Once you click this goal seek, set a cell. Which cell you want to change? This cell you want to change. What you want to change? I want to change to current spot price. It should come to me. 68 is the current spot price. Then by changing which cell you want to get this figure, by changing this cell only I want to get the figure. Just put it here. It will click out to give you the answer. What is that figure? That answer? Go to here. Check. Answer is what, ma? 14.25 is your yield.
Maturity.
If you put yield YTM as 14.25, your current market price is matches. Correct? Your current prices is matches. Thereby I got the YTM of 14.25 by using the goal seek formula. Okay. Then the last question is what is the stand of Agnesh when the market price is like this? What is Agnesh stand? Agnesh has to think whether to buy or not to buy. That question is asking. The current market price is 1025, whereas the value of the bond as we analyzed is 1034 rupees. Whether he has to buy or not to buy.
Has to buy. He has to buy.
For that, you are going to get 2 marks. So current yield we identified 14.262% is the current yield. Correct? Then what is the yield to maturity YTM? We got it 14.23. 14.25 or 424 it came. So this is the answer. 14.23 is the answer. Then what is the question? Fourth question. Should Mr. Agnesh Desai invest this bond? Yes, because no, because cannot be decided with the given information. Yes, because current price is less than the fair value. So these are the 4 options. I want to select. It cannot be this answer. Cannot be decided with this given information. Is enough. This much information is enough. Now what we have to think is yes, because the current market price is
The bond is more than fair value.
fair value. Fair value is 1,034 rupees. Current market price is very 1025. So I can go and invest it. That is the answer for this. You are going to get 2 marks. Bond valuation. You can do this valuation also. Time is 5:45. So let us start this also. This alone. Is it fine?
Fine.
Yeah. If you are comfortable, we'll conclude this also. This also we can make it. It's only the same bond, nothing else. So bond valuation available. Anyway, we will start one more. This will start work it out. Okay. Is it fine for everyone? So that I can
Yes, sir.
take. Yeah.
Yes, sir.
We'll work out one more problem so that anytime you can reach me. That is out of the this one. But as for the today's case study session, we will try to conclude more also more problems. If you wish, I can take one more problems also. One more problem. So this case you can just read it. You are evaluating the yield of. Can you read somebody so that I can make a note of it?
You are evaluating the yield of rupees 1,000 face value callable bond with a 10-year maturity and 9% per annum coupon rate, semi-annual coupon payments. The bonds can be called back at 110% of par value in 3 years. The bond is currently trading at 950.
Fine. Call back at. Current market price is how much?
950.
950. So this is the given information. It is semi-annual. Huh? You just remember this is a semi-annual coupon bond. Coupons are received semi-annually. It means every half yearly you are receiving. Total per annum is 9%. Half yearly how much you will get? 4.5% interest you are going to get annually, semi-annually. That is what he is trying to say. So let us complete it fastly so that time is getting up. You are able to see my screen?
Yes.
Okay. So let us put here period 1, 2, 3. It is a 10-year bond, right?
Yeah.
10-year bond means semi-annually how many periods will come payments?
20.
Exactly. See, all you guys are able to immediately grasp it very fastly. Really great. It's not that batches are priced, but very interactive batch. Then next is period coupons. Nothing but cash flows. Cash flows, how much, ma? What is the price of the bond days face value is how much?
9%.
1,000, no? 1,000 rupees, right?
1,000. Yes, 1,000, sir.
So 9% means 90. So 45 is our
40.
semi-annual. Correct or not?
Yes, sir.
So good. On the end, you are going to get how much? 1,045. Then yield. How much yield is given? 9%, right? 4.5%. So equal to 1 divided by open bracket 1 plus or closing bracket whole to the power of 8. This is a discount rate. I know you guys are already overloaded, but I had no option to close this. As soon as possible, I'll try to close this. And then what happened? Something I wrong. F4. Enter. Okay, so this is the discount factor. Discounted cash flows. What is discounted cash flow here? Into discount factors. Hope you are following me. If not, you please let me know. Okay. So what is this? 1,000 rupees is coming here. Total value is 1,000, it's coming. However, what is current market price? Current market price is
950.
950 only. How come? Correct? 950 only. So again, I will go to the goal seek option, go to data, go to what if analysis, take a goal seek, and tell that I want only current price as per the market 950. Change the market price as yield can be variable. So I will put that as a. So I got a 950 as a value. I got 950 as a value. I hope it is visible. Though it is a small, I made it because I had no option because it is a little lengthy answer. So 950 is a correct. What is the rate of interest? 4.9. It means what is annual rate of interest? This into 2. Nothing but 9.80 is the rate of interest, actual rate of yield you are getting. But now it is selling at 9%. Now what is mod duration? We will identify the duration by making a percentage of this. What is duration? Duration is this equal to divided by hope it is going very smoothly. If not, I am very sorry. I'll just try to explain you, no worry. This is the percentage you are getting, and the duration equal to percentage of the weight into period. So nothing but total duration is equal to 13.41. However, this is I have to divide it by 2. The actual duration of the bond is 6.71%. 71 times 71 years, you can say. Within the 6.71 years, my weighted average cash flows are recovering, not to 10 years. That is what the meaning of this. Then what is modified duration? This is a duration. This is called duration. And what is modified duration? Modified duration. What is the modified duration of formula? You written down, no? Is equal to Macaulay duration. Duration divided by what? 1 plus
I interest.
1 plus YTM divided by N, close the bracket, enter. So in this modified duration will take, by already duration we know, duration is 6.1 divided by 1 plus YTM is how much? All divided by 1, close. This is only an Excel formula. You can just work out.
सर एक्सेल शीट दिख नहीं रही है पूरी तरह से.
You're not able to see.
I can see, but
You're not able to
only
see?
only few entries are showing wherever you are making calculations. I can't see that
Is
area.
it? Oh,
Yeah.
No, it's visible.
somebody, maybe your network is like that. Maybe you just check that network. Okay, modified
Now
duration is,
now it's visible.
yeah, now modified duration is 6.10. See, modified duration, as we already seen, What is the formula for modified duration? 1 minute, I'm showing you. Modified duration is Macaulay duration divided by 1 plus YTM divided by N. N is nothing but number of period. Since I have taken a YTM of 1 year YTM 9.8, that's why divided by 1 I have taken. If I take the top one 4.8, then divided by 2 I can make it.
So there's one request. Could you please share that Excel?
Sure.
Because
yeah, all workings are there in that. No, it will be good for you to review it also.
yes,
Surely I will share it. Okay. That's all. So I think today's session we covered all the options valuation, then the YTM, then market price. Already current market price we know this, and duration we got it. Duration you just recall it. I'll try to explain again. Percentage into period. Okay. So this is the total formula for this. The way of calculate it is easy. Bond valuation is easy. Only options you need to concentrate. That I hope you got it a little better way. I very fastly grabs in the options. Otherwise, bond valuation is only of cash flows and discounting it. That's it. So hopefully, discounted cash flows you got it, and then the duration also you got it. How this duration is? This is only weights. What weights we have taken? We taken total 950. Of that, 42 is how much percentage? The weights of that we have taken. That weight is multiplied with the period. So that weighted average of the cash flows are considered as duration. That duration, each moment we are taking a duration total of it is 13.41, which is actually to be divided by 2 because it is a semi-annually we have taken. So yearly we have to calculate. It is years. It is 6.71 years. Then what is modified duration? Modified duration is a Macaulay duration divided by YTM, 1 plus YTM by N. This is what the modified duration. What is modified duration is always talks about is times. 6.1 times of changes will be there in. If the YTM changes, the price will go accordingly. The 6.1 times of YTM changes. That is what the modified duration says. So I think today's session we have concluded with the both fixed income security options and bond valuation. So is I can see your tired faces today's. I understand. Very sorry for my side, because very late session I have taken. I thought it will be start by 2 o'clock, but anyway, if I taken 2 o'clock, we can take at least to 5:30 to 6. Anyway.
That's fine, sir.
That's fine, sir. No problem.
Anytime you can reach me. My number is there. You can take my number and call me. Okay.
So please do share this Excel sheet so that we can see the entire working.
There to coordinator so that they will share you accordingly.
Okay. Thank you.
Is there anybody here? Coordinator? Vijay Kumar sir? Vijay Kumar sir or somebody? Since it is late, they are also little waited. They waited, but maybe they will announce something.
Do we have class tomorrow or this is the last day, sir?
Nah, that option updations you need to get it from them only. I'm just an faculty. How can I reach them?
In fact, we have not received the PPT of Muralidharan, and morning session also we required.
Try to communicate to that coordinator.
Yes,
let us call him. I'll try to call him. How was the session? Okay only. You can able to follow, right?
Very good, sir.
Yes, sir. Yes.
Yeah, today's session is completed. Can you conclude it because somebody has to be there. This is faculty Sarpabhushan. This yeah session is completed. Somebody has to conclude it, right? Yeah, yeah. Please come into the session. Okay. So you will be coming. So hopefully you all got the answer whatever discussion today's happened. Only some person feeling like options are little confusing. Yes, because of that spot price and exercise price, put and call options make at one go it will obviously everybody feel like a tough. But
No,
what
if you practically if you do, that is definitely it will become.
correct. What maximum extent I can make it very easy or
Like your presentation
try
very good, sir.
yeah
Your
okay
presentation and your explanation,
kind of
definitely it is went on a smooth manner. We're very much thankful for your
kind of
full explanation.
so anytime that kind of no doubts are there you can reach me, we'll discuss. Okay, but don't forget to book slots. This is what they yeah, take immediately, not even prepared also. Tomorrow once this session is complete you get the certificate from the institute. Immediately after seeing that certificate you book the slot.
Slot.
Tomorrow, day after tomorrow, you write an exam. Whether you are prepared or not prepared. No, 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 no. It is not that you are not going to prepare at all. I am telling you are not going to prepare until unless you are booking that slot. Okay. Try to take a session as
No,
soon as
that's correct.
possible.
That's correct.
Yeah. Then only you will be able to. Somebody has to come here.
So we just leave the meeting. We don't come.
Hello. Yes, sir. Yeah, yeah. Okay. They are having some queries. Anyhow, you can discuss with them by through the group or whatever the way you can contact. I will try to conclude from my side. Okay. Thank you. Bye bye. Okay, that's what they are trying to say, as exactly you said. So we'll conclude the day for this. Anytime you can reach me or you can reach to sir GKR sir. Hopefully you can again meet in the GKR sir's that fast track. I will brush up all again in the fast track session and all. I will give with it is a free of cost sessions. He will keep encouraging the valuation aspirants by giving so many sessions. His explanations of classes will be ultimate. Only what tips I can give before concluding this session. If you are not bored, I can tell you because
Yes,
the
sir.
clearing certificate is much important than anything else. Practical aspects may not be the options or bond valuation. Practical will come on the different way, practical scenarios. To get the certificate, yes, of course, we need to be very thorough in this whole concept. That is how the board also expect us to do this. So what tips I can give you is first you take all material given by the Gopal Krishna Raju sir, which is available in his blog. Okay, I think you are already well aware about that blog. Okay, you can download all the slides available. FT9 slides. It is freely available. Download that. Take a CFA material. Few practical aspects also covered in CFA material, which you can get it from me also, or you can get directly download from the website. That is there with me. In addition to that, some practical aspects. There are so many exam kind of questions or what can see exam practical what they explain. What they expect from the valuer is there are three income based method. If you want to value the problem, income based method, what are all required? One is cash flow required, correct? Cash flow required. You need to apply the discount rates. For that, discount rate is required, and you need to understand the weighted average concept, how that discount rate is arrived, and some scenario they will give, and finally bond valuation and option value. Only these three scenarios they will ask you in the practical aspects. Cash flow purpose, they will expect that what is that discounted cash flow, that FCFF, FCFE would have been
Free
already
cash flow.
discussed. Okay, that free cash flow to the equity and free cash flow to the firm. That is always goes with the how to get the cash flows. The second one is discounts. That is called weighted average rates. We are the WACC, the WACC calculation cost of equity, cost of capital. Those things only will be there in the exam. Then third is bond valuation, what we did today. This one will be there for 6 marks and 8 marks. And what is that? Option valuation, what that kind of options, what we discussed today will be the option. This is a 20 marks area. All the very best for you all to get as soon as work registered valuer certificate. Okay. See you then.
Thank you,
Thank you,
sir.
sir. Thank you, sir.
Thank you.
Bye.
Thank you, sir.
Thank you. Thank you.
Yes, sir.
Anybody aware? कल session है? This was the last session today.
That is a suspense thing, man.
I think we need to.
No, sir. No, they
go
have
to
given a
group and
WhatsApp
ask
message that it will be 11 a.m. tomorrow also.
It's written 11 a.m. for today also, but we have not started at 11.
We can call the Vijay Kumar and we can ask.
I think I have to call him only.
Arun. Arun.
Yes, sir. Yes, sir.
Call that Vijay Kumar Gupta,
Yes,
because no one that you sent a message at somewhere
Sir,
what time? 2:43.
this message sent at 2:40 p.m., sir.
2:43 sent a message stating that tomorrow class is there
Yes, sir.
at 11 o'clock.
Okay, sir. Let's call them.
His number is busy right now.
Busy, huh?
You can call to Sunil, sir, also, no? Okay.
The morning I called Sunil. Sumit Adda.
No, sir, I think coordinator, I think it's Sunil, sir.
Still, how can we complete like 50 hours in 5 days? No? It will be 60 also, I believe.
That is what Manoj Sharma ji asking.
As per calculation, it should be at least 6 days because 8 hours multiplied 6 is 48 hours. So
Like take a 9 also, you can take it 45 is what that's all.
5 years discount, sir.
Even consider 9 hours daily.
9 hours daily, yes.
then only it's 45. 50 hours nahi hote, sir.
And one of the faculties took extra 45 minutes. I remember.
Few days we have taken till 7:30 also.
Yeah, Ravindran sir has to.
Yes.